This conference will now be recorded.
Well, that's not intimidating at all, is it? Let's keep it clean, people. My name is Chris Murphy, and I'm a CPA with with BKD. It's a CPA firm. We do quite a bit of work with nursing home cost reporting and accounting and tax and those types of things. I've actually been teaching this day of the course for, I don't know, probably going on 12 or 13 years, and I probably will continue to do it until they ask me not to anymore. I'm glad you're here, and I know that the accounting financial management day is not anybody's idea of a really good time. And we kind of have to balance when we speak about this, giving you some practical information, things that you can actually use, with things that you can actually use to pass this part of the exam. So we're going to be sort of going in and out of both of those things. But my objective is to give you some things that you can use back in your facilities. And my other objective is to give you the information that you need to understand the financial management piece of your exam. You notice that I didn't say my goal was to turn you into accountants, and that's because it's not. But what we have to recognize is that when you look at how you perform as an administrator, one piece of that, you've got your survey results, you've got compliance, and you've heard a lot about compliance through this course so far and the various regulations that we have to comply with. We're the most over-regulated industry other than nuclear power in the States right now. So it's a daunting task. You have to look at staff and resident satisfaction and nursing home compare scores, and all of those things are things that you'll be measured on. But financial performance is kind of a big one, and it's one that I think as an industry we probably need to continue to develop and get better at, because the financial challenges that we face are pretty significant. So with that, let's start with let's see. Here we go. Let's talk a little bit about financial management and what we mean when we say that. And the first piece of it is, I think, that when we talk about financial management, a big piece of it is just understanding the financial results. If you get a balance sheet or an income statement or a P&L, whatever you want to call it, can you look at that and make any sense of it? And we'll spend some time in those financial statements talking through what that means and what to look for and what the numbers are. So that's a piece of it. The second piece of it is, setting expectations for financial outcomes and measuring performance against those expectations. That process is called budgeting. So we basically say at the beginning of a period, what do we think our financial result is going to be? What's our income going to be by the end of this period? And then measuring against what those expectations were so that we understand. But that doesn't really do you any good, because one of the things that you've also got to understand is if you make a change in operations, let's say that you decide that our staff are getting, that we've got some key staff that are sort of nearing their breaking point, working the hours, would it make sense to maybe bring in some contract labor and relieve those staff, and how does that counter against overtime and all of that? Financial statements tell you what happened as a result of the decisions that you make. So, making changes in operations. So here's something we want to improve, and then making sure that we understand the results of those decisions. So that's where we are. All right. So I'm going to tell you right now, the section that we're going to start with is kind of getting the hard part out of the way, and it's probably also maybe the least exciting part of the day, so stay with me. But this is kind of the foundation that we're going to build the rest of the day on. And what we're going to try to teach you is 2 semesters of accounting in about 90 minutes. And we'll see how we get there. And we're going to, this part of our talk is going to be really terminology heavy. So making sure that we have the tools to understand the financial statement starts with getting some of the terminology down. So as you have questions or need clarifications, please speak up. I want to make sure that we all kind of move together. I suspect that we've got differing levels of understanding of financial statements. So I want to try and keep us all sort of grouped together as best we can. For those of you that have a financial background maybe and see a better way to explain something I've explained or have commentary, please jump in and help me out here. I'm certainly receptive to that. So we're going to start with terminology. And the big piece of it is the overarching idea is GAAP, G-A-A-P, or Generally Accepted Accounting Principles. The idea behind GAAP, or Generally Accepted Accounting Principles, is that those are the rules that we use when we prepare financial statements. And that's an important thing, because if you go from one organization to another, or you try and compare your financial statements to somebody else's financial statements, what you don't want is a difference in how they do the accounting to paint a different picture of the financials or of the performance of the building. What you're looking for is for us to be comparing, it's tired, but comparing apples to apples and oranges to oranges. We don't want, basically, if I decide that I want to record revenue based on when the cash hits my door, and the facility down the street records revenue when they've provided the service, and we'll talk about that concept a little further down the road. Those are things that make the financial statements, or can make the financial statements, look really different. So making sure that we're preparing financial statements consistently, that's the point. That's the point of GAAP. Everybody plays by the same rules, even in accounting. That's why accountants are such a conflicted, rigid group of people. I had a client tell me one time that accounting isn't a profession, it's a disease. That was hard for us to argue. The next piece of this I want to talk about is the books, this concept of books and records. When you talk about books and records, this is basically your documentation surrounding how you got from, your Oklahoma gas and electric invoice to the utilities number on your financial statements. The books and records basically show how you get from your supporting documentation, or what that supporting documentation is. They leave a trail from the documents you start with to the financial statements, which are the documents that you end up with. That's basically books and records. Okay. The entity concept is one that we probably ought to understand, and it's not too difficult to get your mind around. But the idea behind the entity concept is that the financial statements of your the organization that you're working for, the nursing facility or whatever it is, and these are not nursing home specific concepts, these are just general accounting ideas. The idea behind the entity concept is that the financial statements should only have the transactions that relate to the business that you're doing the accounting for. I'll give you an example of that maybe. When I was pretty early in my career, I was asked to go and review the financial records of a physician that was an employee, not really an employee, there was a strange contract between one of my hospital clients and this physician. I was asked to go review his books and records. And what we thought was probably going on, his expenses looked really high compared to the service that he was providing, right? So we started looking at it, and it turns out that he was running through his financial statements, his personal healthcare expense, the maintenance on his home in Boca, the furniture for his home office, and all sorts of personal expenses. Well, his personal expenses are not part of his physician practice. They're outside. So when you talk about the entity concept, what we're saying is the financial statement should only reflect the transactions or the accounting information that relates to the nursing home, nothing outside it. We good? Consistency is another thing that we need to understand. And when we talk about consistency, what we're saying is that we treat transactions the same way from accounting period to accounting period. So, we measure accounting typically in months or at month ends, right? So we should treat our food costs the same in January as we treat them in February, as we treat them in March. So making sure that we account for transactions the same way over time from month to month. Again, the reason that we do that and the reason that that's important is that if we have a change in the way our financial performance looks, we need to be able to see that it's really a change in something in our operations and not just a change in how we counted the beans, right? So consistency is important to make sure that the financial statements aren't distorted for some difference in how we do the bookkeeping. Full disclosure. So remember, when we talked about the entity concept, what we said was the financial statements should only include the transactions for, in our case, the nursing facility. What the full disclosure concept says is that it should include all of the transactions of the nursing facility. So we don't have some transactions that are getting booked elsewhere. We've seen this in some circumstances where, an operator might have 2 or 3 facilities, and one facility for 1 month can't pay the payroll, so facility 2 pays facility 1's payroll. You need to make sure you still record that on facility 1's books, right? If otherwise, facility 1 doesn't have all of their expenses in there. It's not a complete or a full disclosure or an all-in transaction. Likewise, facility 2 has violated the entity concept because they've paid an expense that isn't really theirs. Does that make sense? So getting things in that right bucket, all the transactions is what we're talking about with full disclosure. Okay, time period is another one. We typically do our financial statements on a monthly basis as of the end of the month. Everybody with me on that? So we do our financial statements on a monthly basis at the end of the month. When you look at your financial statements, you might see 2 columns. One of them is for the month ended, and one of them is for the period to date. It's important to read the headings at the top of your financial statements to know what those are. Did you guys print out your, you had 2 documents. One of them was, oh my gosh. One of them had a trial balance sheet, income statement in it. Yeah, you've got it. Everybody see those? I want you to look at the balance sheet. It'll say Murphy Manor balance sheet. It's a little half pager. And I want you to look at the income statement, which should be the page right behind it. So when we talk about time periods, for the balance sheet, you see at the top it says December 31st, 2019. Everybody see that date? What that's telling you is that as of December 31st, 2019, if you look down there, the first line on the right-hand or the left-hand side is cash. We had $71,100 of cash at December 31st, 2019. So as you look at the financial statements, the first place your eyes need to go is to that date so you can see what you're looking at. If we look at the income statement, which is the next page there, you'll see a line there that says year ended December 31st, 2019. What that tells you is that for the 12-month period ended December 31st, 2019, we had $2,778,900 of revenue, patient service revenue. So you know what period that's for. But as you look at the headings, and it sometimes shows up in the, at the top of the columns instead of at the top of the page, look at the headings so you know what period you're in. That's the most
I'm sorry, sir.
Yes.
Can you go back? What page are you on? I got lost trying to find the PowerPoint, the page you were talking about first.
It's not on the PowerPoint. It's actually in the second document.
On our, okay, the handouts we got on the email.
Yes. Yep.
Okay, I'm sorry.
No, you're fine, and it's kind of a bizarre setup because maybe what I can do is look at it here. So it looks like that, if you guys can see the balance sheet. So, no, I'm glad you asked because I'm keeping up with the people in the room pretty good, the ones that are still awake. But the folks that are remote, I can't see what you're doing. So, yeah, maybe stay with me. Okay.
Yeah, I just got a
So,
little behind. Thank you.
all right. So again, the balance sheet, 12/31/2019. That means that on December 31st of 2019, we had $71,000 of cash, and our third-party payers, Medicare, Medicaid, and patients owed us $134,000. But looking at that time period is important. Likewise, on your income statement, this says year ending, right? So we know that this is for a full, this number. The net patient service revenue is for a full year. What you will sometimes see, though, is on these financial statements, if you're using QuickBooks or Great Plains or some of the standard accounting programs that are out there, you'll have a heading that says month ended and year ended December 31st, 2019. You might have two columns here. One of them says month ended December 31st, 2019, and one says year ended. So I guess what I'm saying is pay close attention to those dates. We good? So when we talk about time periods, here's the other thing. Time periods are strange in Oklahoma. And the reason they're strange is that our state is on a June 30 fiscal year end, meaning that when you report, when the state reports a year's worth of transactions, they measure it as of June 30. So their fiscal year end is July 1st to June 30. Okay. United States federal government is on a September year end, meaning that their transactions are measured, if you look at their year, their fiscal year, it's October 1st to September 30th. The rest of the free world is on a December 31st year end, right? A lot of us are. Depending on your nursing facility, if your facility is owned by a state agency, we have some that are owned by hospitals and so forth, those guys may report normally on a June 30 year end. So when you ask the question, what's our fiscal year? The question you're asking is, when do we measure a full year end and do a more robust closing on our books? Okay. The reason Oklahoma is weird is because for our nursing home Medicaid cost reports, all of them are on a December year. We always report on a December, I'm sorry, I lied, scratch that. We always report on a June 30 year to follow the state's fiscal year. So we always report on a June 30 fiscal year end. That sometimes requires some accounting magic is not the word I'm looking for, but it requires some gymnastics. If your normal accounting period, if you report for taxes, for example, on a December year end, we actually have to sort of add financial statements together to get the Medicaid cost reports done. For a lot of facilities in Oklahoma, they're on a December 31st year end for tax reporting, and they're on a December 31st year end for Medicare reporting. So knowing your year ends. The reason, I think the main reason that is important is that those time periods, at the end of those time periods, so if we have a fiscal year end, the closing processes that we do, or the processes that we do to sort of make sure that the financial statements are correct, are a little bit more involved at that period of time. So we do a hard close, or again, a more diligent close at our normal fiscal year end. But if we have to do cost reporting at a June year end, that's not our normal fiscal year end, sometimes things go a little wonky. Okay. Objective evidence is another thing that we want to talk about. The evidence that we use to prepare financial statements should be able to go back all the way to some kind of supporting document, okay? Whether that's a Cisco invoice for your food costs or a Reliant Rehab invoice for your therapy, or your payroll journal for your payroll costs, or your payroll, your ADP or Paychex or Paycom or Southwest Payroll or whoever you use. We should always be able to get back to a source document and trace that source document all the way through to the financial statements. I'm not saying it's always easy to trace that source document all the way to the financial statements, but it should be at least doable. So when you're looking at a financial statement, like the income statement that we were just looking at a few minutes ago, when we're looking at a financial statement like that, you want to look at that and say, well, why is our purchased services so much higher than it used to be? You should be able to drill down to a point where you can actually see a purchased services invoice of some sort for nursing contract labor or contract rehab or something of that nature. You want to be able to drill down and see granular level detail, and you want to be able to see that supported. The reason that's important is that objective evidence is what Medicare and Medicaid, the IRS, if you have an external auditor, your external auditor, those are the documents that your regulators will measure against. If you've received funds, provider relief funds from HHS or some of the state funds, and you are selected for audit, they'll be looking all the way down to that source documentation. So that's what we're auditing against. Questions on that first slide? We good? All right. Here's the next piece of it, and this is one that I really struggled with in my 2 semesters of accounting. I didn't have the 90-minute version. I had a full year of this good stuff, and it was not nearly as exciting as this is. The accounting equation works like this, and the easiest way to see it maybe is to look at your balance sheet in that other financial packet. For those of you guys that are online, we're going to go back to that balance sheet. Keep that balance sheet and income statement pretty handy, because we're going to refer to that and the trial balance, which I think is the first 2 pages in that packet. So those first 4 pages we're going to spend a lot of time in. If anybody in the room doesn't have one, I've got some here too, so feel free. The accounting equation looks like this. We have assets. Assets are the things that we have. So if you look at the left side of your balance sheet, that's our cash, our accounts receivable, which are amounts owed to us from somebody else, whether that's, we provided services to a Medicare beneficiary and now Medicare owes us for that claim. That's what accounts receivable is. Prepaid expenses, we may pay our insurance bill once a year, but it reflects the whole year, so we don't put it all in that same period. Our inventory, if we have a food or supply inventory or linen inventory, depending on what your protocols are. Our capital assets, that's going to be our building and our equipment. All of those things are things that we own, right? Liabilities are what we owe, so amounts that are owed by us. And if you look on the right-hand side of your balance sheet, if you look on the right-hand side, you'll see things like a line of credit. We owe the bank for that line of credit. You'll see things like accounts payable, where we've gotten a food bill in, we received the food, we got the food bill in, we haven't paid it yet. That's an account payable, an amount due to a vendor. You've got accrued liabilities. So our employees provided service to our residents, and we owe them at the end of the pay period, but maybe we haven't paid them yet. That's an accrued liability as an example. So those are amounts that we owe. So the accounting equation is assets are the stuff that we own or that we control. Liabilities are the stuff you owe, and equity is what's left over. Okay? So we've written it out in the traditional accounting equation way, where assets equals liabilities plus equity. A better way to look at that, maybe, or then a more relatable way to look at it is like your mortgage. You own your house, right? Well, kinda, right? You control your house. No, I have 3 teenage daughters. I'll tell you right now, I don't control anything about my house. But you control your house. That's an asset. What do you owe on your house? Not the amount, just what's it called? Mortgage, right? We owe a mortgage. That's the stuff we own. When you take what your house is worth and you subtract what you owe on it, what are you left with? Your equity, right? That's the part of your stuff that's yours. When you look at the accounting equation, that's all it's doing. We take so if you were to write house, mortgage above assets and liabilities, that's a pretty good way to think about that. Does that make sense? If my accounting professor had explained it that way, I would have gotten a much better grade in that first semester. We'll have to see how it goes. Okay, terminology break, financial statement terms. Again, we're back to some terminology, and we've sort of covered a little bit of this. I'm going to start with the income statement. The income statement is this document. And maybe the thing to do is to switch over to that. So that's your income statement. The terminology we're looking for here is, the first one is revenue or income. When you talk about revenue or income, those are that's the amount that you have earned, okay, for providing service. So if you were to look at, if I have one patient and it's a Medicaid resident, and I provided them service in August for the whole month, I'm going to take 31 days of August times whatever my Medicaid rate is. If I'm getting paid $170 a day by Medicaid, you're going to take 31 days times $170, and that's math I can't do in my head, but that's $5,000. That $5,000 is revenue to me because I've provided the service and I've earned it. Okay. The next section here is our expenses, and your expenses are the amounts that you have to pay to be able to earn the revenue that you earn. So, for example, the biggest number on there is our salaries and wages. How much did I pay my employees for this period to earn the revenue that I earned? Purchase service we talked about. The quality of care fees. Here in Oklahoma, we have a patient days based tax that we pay. Depreciation. We'll talk about that a little bit more. You see from your expenses, these are all of the expenses that term we use where we say earned for income. We use the word incurred for expenses. It's kind of the same thing. We are obligated to pay an expense because we have used the supply, benefited from the employee's effort. We bought the service. Incurred means we're on the hook for it. Just like earned means, from the patient's perspective, that we've done everything we need to do for that money to be ours. So income is earned, expenses are incurred. Everybody good with that? At the bottom, you've got a number that's your net income or your loss. Don't confuse income and net income. Income and revenue are the same thing, amounts that we've earned for services that we've been provided. Net income means that you take something and subtract something from it. So net income, this is also called profit or loss. Net income is what's left. So if we have what we earned, we subtract from it what we incurred, and if there's still money left over, that's net income. If we take what we earned, revenue, and we subtract what we incurred, expenses, and it's a negative number, that's a loss. That means we spent more than we anticipate for a year's worth of, for this period's worth of activity. We spent more than we brought in. Good. That's basically the big concepts in your income statement. The other piece of this is in your balance sheet. There are a couple of things we need to talk about there. And again, I think this is the third page in your packet. So when you look at your balance sheet, the first thing we talk about, we talked about the accounting equation already. Assets are the stuff we have. Liabilities, this section is what we owe. Equity is what's left, right? Everybody remember that? A couple of other things that we got to talk about though, and the first one is current. You see, we've used the term current assets and current liabilities. What current means is we expect that we can use or expect to use.
Well, just knock on the door. Because I don't either. They all switched rooms.
Okay, current means available for use within a year. Okay? Current means available for use within a year or expected to be paid within a year. So let's think about current in terms of what we've got out here. We've got cash. We can use cash right now, right? That's current. That's available within a year. Accounts receivable. We can't spend accounts receivable, right? And how long does it typically take us to collect? 30 days, 15 days, depending on who the payer is. Sometimes we collect before we provide the service, right? If it's taking us more than a year, that's a problem, right? So accounts receivable, we expect to be able to access the cash on that. Inventory, when is that available? Right now, right? We've got it in a closet someplace. You contrast that with non-current or long-term, our building. We're not going to use our building entirely up in a year, right? It's an asset that we're going to use over time. And we can't just spend our building right now. Right? Same with our equipment. When you look at current liabilities, current line of credit, right? Those typically last how long? I don't know if you've ever done a line of credit, but when you get a line of credit, it's good for a year. And at the end of that year, you either have to pay it off or refinance it. So it's only typically good for a 1 year period. Your current maturities of long-term debt, if you have a mortgage, those are the payments that are due within the next 12 months. Accounts payable, those are amounts that are due to our vendors. Our vendors don't like to wait a year to get paid, right? They're kind of fussy about that. And our accrued liabilities, likewise, amounts that are due to our employees, typically is what's in that number. Again, the employees don't like to wait a year to get paid. So these are all things that we're going to turn around pretty quickly. If you want to look at the financial health of an organization, you look at current assets. How much asset do I have available in the short term in the next year compared to my current liabilities? So I've got to find a way to pay $515,000 of liabilities, right? With $233,000 of assets that are available at the same time. Anybody see a problem there? No bueno, right? That's not good at all. That is not good at all. So that's your current versus long-term. And I think that we've talked about everything else on that slide. Okay, remember I said that we talked about the books and records on that first slide. The books and records I said were, I think what I said was, those are the documents that we use to trace from an invoice or a source document, the lowest level source document we got, into the balance sheet or income statement or into the financial statements, right? So they basically give us the path. The books are made up of lots of different components. I've listed general ledger first. I'm actually going to talk about what the general ledger is more or less a list of transactions for your facility that are categorized depending on what category they go into. Closing. I want to talk about that really quickly, and then we'll get back to the underlying books and records. Remember when we talked about fiscal years and closing and time periods? The reason that's important is that when you close the books, what that means is we make sure at, June 30 is our year end. We make sure that at June 30, all of the transactions that relate to June are already recorded and pulled back in there. So for example, at the end of June, we might get, our pharmacy bill might come 4 or 5 days after the end of the month. We want to make sure that we've got that recorded back into June. Our payrolls, we want to make sure that we've got those documents recorded. So we do some quality checks to make sure that we've got all of our transactions recorded. One of those is a bank reconciliation, where we basically look at the bank and see, do we have any transactions that hit our bank account that maybe aren't recorded in our financial statements? That's kind of the purpose of the bank reconciliation, to make sure that we've got all those transactions recorded. We might look at our accounts receivable and say, here's what we think we're owed. Is there anything in there that, does that all make sense to us? Are there amounts on there that might be in our records that aren't owed? We might look and make sure that some of our big vendors we actually have recorded and that we actually have transactions recorded from those guys. So the closing process is basically bank and other reconciliations. We'll talk about depreciation and interest and some of those things later on, but making sure that we've recorded those things that are manual transactions that aren't in one of these other journals. But that's your process. Okay. Chart of accounts. On this one, I want you to look at your trial balance. It's the first 2 pages of the other document that I handed out. So grab your trial balance and let's look at that for just a minute. We got it? Everybody see the trial balance? Okay. So when you look at your trial balance, your chart of accounts is basically these 2 columns. So these are when we have any sort of a transaction, it's going to hit. These are the accounts that we have to choose from. And what I'd have to say is, if you haven't spent time, if you're in charge of the facility, and you haven't spent time looking at your chart of accounts to know what's there, spend some time knowing what's there. The balance sheet side doesn't excite me all that much. When you get down into some of the revenue accounts, so let's look here for a minute. So for example, my chart of accounts has Medicaid income, Medicare Part B, Medicare Part A, private pay, all of those categories, right? So when I'm looking at my financial statements, you'll notice your income statement just has net patient service revenue. That's one number, right? But those 4 accounts, Medicaid income, Medicare Part B, Medicare Part A, and private pay, those 4 accounts are another level of detail. If you add those 4 accounts up, they make up this 2.7 million. Okay, trust me, I think, I hope. And the reason that we split that out is, if I looked at my financial statements month over month, I might want to know, is my Medicaid income up or down? I might want to know, is my Medicare, the amounts that I've earned from Medicare, is that up or down? If we've got a significant payer, some homes in Oklahoma have a VA contract, for example. That's one that I might want to split out if I've got a lot of VA residents. If I've got a lot of managed care in my facility, I might want to split out revenue to show managed care. So look at that and make sure it meets your needs. As you scroll on down, you'll see salary accounts. You'll notice that I've got a salary account for practically every position in my facility: RNs, LPNs, aides, dietary supervisor, dietary staff, so on and so forth, cooks and aides, the administrator, medical records, all of those positions. The reason is that I actually have to report that level of detail on Medicare and Medicaid cost reports, so I know I want to look at it. That's number one. That's my selfish reason for wanting that done. We see an awful lot of facilities that have salaries in just one account. It's one number, salaries. And when I look at the income statement, it jumps out to me that the expense that we spend the most time managing, right? The expense that we spend the most time managing is our payroll expense, right? I would think that I would want some detail on that payroll. I want it at as high a level as I can get it so that I can actually see it month over month. My aide salary went down. Why did it go down? The other thing that we see quite a little bit when you look at salary is that we're quick. Facilities are sometimes pretty quick, and maybe not in this environment right now. It's a whole new ballgame. But facilities are quick as we have our census go up. We're quick to staff up. We're quick to grow the number of aides that we have on staff. We're quick to grow the number of LPNs that we use, the floor staff. When our census goes down, we're not as quick to adjust that staffing down. And income, the salaries are the biggest number on your income statement other than revenue. That's the one you're going to spend the most time managing. Make sure your chart of accounts gives you enough information to manage that. The payroll reports that you have will give you that information at a detailed level, so I can see how much my RN expense was this month. But when you start trying to compare that period to period, this month's RN expense to last month's RN expense or what have you, when you start trying to compare period to period, now you're shuffling two payroll reports trying to see what happened. If you get it in your financial statements, you can get it all on one report, so you can just see it. Chart of accounts is a pretty big deal. You start to look at this, and a couple of pitfalls that we see sort of people get into. You can see here we've got some employee benefits, so your payroll taxes. You know, this facility had glove expense for whatever reason. Our contract labor, our rehab expenses are going to be out there. A couple of things you want to look for in your chart of accounts. Are we splitting over-the-counter drugs and prescription drugs into two separate buckets because they're reported differently? Are we recording radiology and lab in separate buckets because they are reported differently? Are we recording our contract physical, occupational, and speech language pathology rehab in separate accounts because those are reported differently? I guess what I'd say is look at your chart of accounts and see if it meets your management needs. I got to tell you, one of the things we also see a lot is a single account for insurance. And so when you think about the types of insurance you have, you've got workers' comp, health insurance, property, or building, auto, liability, bonding. And if you think about that, if all of those expenses are sort of lumped in together, do you manage property insurance the same way you manage health insurance or workers' comp? No. So get those things split out so that you've got, and they're all big numbers, or a lot of those are big numbers. So make those things split out. But don't overkill it too. I was looking at a facility the other day and trying to get their chart of accounts or getting their trial balance ready for cost reporting. And I ran across a fabric softener expense account. So, you know, I'm looking at that kind of going, what in the world had to go wrong that somebody decided that fabric softener expense is something they wanted to monitor? You can't make this stuff up. So I guess what I'm saying, the lesson to take away from it is you don't need fabric softener split out. Laundry supplies is fine. But look at that account. If it's got little piddly amounts in it, don't. You know, let's not get crazy here. Sorry about that. It's my annual fabric softener rant. Semi-annual, I guess. All right, so then the other thing we got to talk about is journals. And there are journals for certain types of transactions. So for example, we have a cash receipts journal. What that records is the deposits we make, how much they were, and who they were from. Our source document typically is a receipt or a remittance advice. That cash receipts journal is also going to post into your accounts receivable. So you basically are applying the payments you received against the receivable or the amounts that somebody owes you. Cash receipts journal just documents how much you got, who it was from, or what resident it applied to. And it would be really good to make sure that you apply it to the correct period. So if we have, for example, a Medicaid resident, you have July and August, which both have 31 days. You have a resident in the building in both July and August. Your Medicaid payment or your private pay payment for that resident will be the same in those subsequent months. And it's sometimes, depending on how your accounting system works, it's tempting to look at that and say, well, I got $5,426.18. And so I'm just going to apply it to whatever number I find. The problem is in your financial statement, there can be two of those different amounts. So make sure you're applying it to the right one. Otherwise, you'll be looking at your accounts receivable and thinking, gosh, this is, I've got a past due amount. Always apply it to the correct invoice where you can. Okay, a billing journal is where we record the revenue that we've earned, right? So again, the example that I just gave of a resident being in our building in July and August, and them, us being entitled to $5,462.13 or whatever the number I said was, we're going to use the billing journal to record the amount that we're owed. Okay, at the time that we've completed the service and fully earned that, that's the amount we owe. That's the amount that we are owed for providing service to that resident. So when you look at the cash receipts journal and the billing journal, you have an entry that basically says, here's what we've earned. When we get paid for it, we have another entry that says, here's what we got paid. So those two sort of work together to be able to tell you at any given point in time, what do our residents or third-party payers owe us? So they're both parts of what we call the revenue cycle. The next piece of it is accounts payable. Accounts payable is where we record amounts that we owe our vendors, not our employees, just our vendors. So, there's a fairly involved process there, but we basically ultimately approve an invoice to say, yes, we got all the stuff that we ordered. We're going to approve that invoice. That invoice goes into accounts payable at the time we get it approved. If we do it that way, we can tell it pretty well at any given point in time how much we owe to our vendors. Most systems will tell you when it's due. So you'll have an amount, you'll have a vendor name, you'll have a date received, you'll have maybe a due date, and you'll be able to trace that back in your system to what that vendor provided to you as well. Cash disbursements journal has a check register. It basically shows the checks that you wrote or the transfers that you made out. Payroll register. Boy, that's a fun one. The payroll register is, or the payroll journal is something that contains all of your employees' pay rates, their withholding elections. Maybe if you have a PTO policy, it contains how much their PTO that's owed to them is. If you have, if you have a withhold for health insurance, it shows the health insurance. It shows their federal tax withholdings, their state tax withholdings. All of that payroll-related information goes into that payroll register or payroll journal, such that at the end of a pay period, we accumulate the information off of the time clock, put in the hours, and now we've got an amount. We've got all of the pieces of information we need to process or run a payroll. So we've got kind of that base information set up all the time and maintained, and then we add in the hours at the end of a pay period, and that's where our payroll expense comes from. And finally, there's the general journal. And the general journal is just a document where if we don't have another journal to record a transaction, it goes in the general journal as what we call a journal entry. Strong preference is to use the general journal as little as possible. If you've got journal entries, most of the errors that we see in accounting records that we look at over the years haven't come from one of these other journals. They've come from somebody posting a journal entry backwards or making a manual entry and just kind of squirreling it up somehow, to use a technical term. So general journal is high risk behavior as far as accountants are concerned. Okay. I want to talk a little bit about cash versus accrual basis. You guys are holding up okay. You're doing good. I appreciate it. I know this is not the most riveting, topic. I appreciate you staying with me. When you look at cash basis versus accrual basis, the difference between those two is when you record a transaction. So on the cash basis, we record transactions when the cash changes hands. So we would record revenue on the cash basis when we get our remittance from Medicaid, or when the resident brings in their funding or their payment, or when Medicare sends us a payment or whatever. So we would record that revenue at the time that the cash changes hands. Expenses are the same way. We would record our expenses when we pay the bill. So when we write the check, that's when it gets recorded. All right. Remember I talked earlier about earned and incurred? Does anybody have any vague recollection of that? I barely do, but incurred means that we have an expense that we're on the hook for. We've done everything that we've gotten the benefit, so we owe the money. Earned is basically we've done everything we need to have somebody owe us. Accrual basis accounting, basically you record accounts, you record transactions when the revenue is earned. So not when you get the cash, but before you get the cash. We've earned it, it goes on the books. Likewise, we record our expenses when the expense is incurred. So at the time we've got the invoice, or at the time that we have, basically the time that we're on the hook for that expense. So cash basis is based on when cash comes in or cash goes out. Accrual basis is based on when we earn the money, when we incur the expense. I'm going to give you a couple of illustrations to kind of hopefully shed a little light on this, because it's sometimes a little bit hard to get your head around the distinction. And to be perfectly honest with you, it's something that I struggle to explain. So stay with me. Okay. We have a gas bill for February. So basically, let's assume, which I know this doesn't really work this way, but February 1st through February 28th, 29th, whatever we've got, we have a gas bill that covers that period. On the cash basis, and let's assume also that that bill is due by the end of March. Okay, so we write the check for it March 20th or whatever. Okay, so the service was provided to us in February. That means we incurred that expense in February, right? We used the gas in February, so we're on the hook for it. It was paid in March. On the accrual basis, we would record that invoice, or we would record that expense in the month of February. So it would be in our February financial statements. On the cash basis, we would record that invoice in March when we paid it. We good? Okay. So let's think about that for a minute. When do we get our February financial statements? March, right? Hopefully. If it's much beyond March, your accounting processes need an overhaul. We get our February financial statements in March, right? When do we get our March financial statements following that logic? In April, right? Okay. So we have a spike in our gas bill in February, right? And let's say that the only information that you have as an administrator is the financial statements that you get. If we have a spike in our gas bill in February, on the accrual basis, where we record when the expense is incurred, when do we find out about it? In March, right? Everybody see that? We recorded it in February. We see it in the February financials, which we get in March. If we record that on the cash basis, when do we see it? So we recorded on the cash basis, meaning we paid it in March. So it's in our March financial statements, which we get in April, right? You want to know the month following that you had a spike in your gas bill, or do you want to know 2 months later? So it's a timing issue. I mean, I think in the world that we live in now, information quicker, as long as it's accurate, quicker information is better. All right, so let's look at our Medicare days and kind of take the same approach. Let's sort of talk through that. If we have a patient for the entire month of February, a Medicare patient for the entire month of February, when did you guys know when we typically bill? Most facilities have a standard that, we bill for Medicare patients that are in the building at month end, or that were in the previous month by the 10th day of the following month, not the 10th month of the following year. That will get you in trouble. The 10th day of the following month, all right? All right, so we bill on the 10th. When do we collect? Allegedly, if it's a clean claim, 10 to 14 business days. So we're collecting that when? End of March, hopefully, right? Just in time to meet that second payroll in March. That's how we typically see them. All right. Same logic though as we had with the gas bill, right? So when did we earn February days? When did we earn our Medicare money for that resident? February, right? We provided the service in February 28th, 9th, whatever. Leap year throws me off. February 28th, 29th, we've earned it, right? That's ours. That's ours. We're going to record it on the accrual basis when? February's books, right? Because we've earned it. So we'll see that revenue in March, right? In the March, not in the March financial statements, but when we receive the February financial statements in March, assuming you receive your financial statements in the month following, right? What if we recorded on the cash basis? What month's financial statements does that revenue go into? We collected it, say, March 28th. It goes in March's financial statements, right? When do we see March financial statements? April. All right. So if you had a Medicare spike and it shows up in March's financial statement, if we had a spike in our Medicare business, or in the environment we're in right now, if we had a significant decline in our March skilled nursing admissions, right? We won't see the impact on our financial statements on the cash basis until we get our March financial statements in April. If we record things on the cash basis, we'll see them in our February financial statements in March. As an administrator, would you like your information in 30 days or 60 days? 30, right? All right, so now we've looked at two. We're going to ignore the liability insurance thing. It's too much trouble. What we're going to talk about though is, think about this for a minute. Our Medicare revenue is up. Our gas bill is up in the same month. I think that was sort of the example that we gave you, right? They're up in the same month. If you're on the cash basis, when do you find out whether your February was good or not? If you're on the cash basis, you find out in your March financial statements that you get in April. You want to be reacting to a bad month 2 months after the fact? Guess what? Not only is February going to be a bad month, March is going to be one too, because you don't know, right? So it's not just the individual transactions, it's how all the pieces kind of mesh together. I don't know if you picked up on this, but I kind of have a preference for accrual basis accounting. A lot of people still do cash. Your tax filings are typically going to be, your corporate taxes, and if you have a holding company or whatever, the owner's taxes are going to be typically done on the cash basis. Medicare and Medicaid filings are required to be done on the accrual basis. From a management perspective, accrual basis is superior. I mean, it's just better. It's better information. It's better from a timing perspective too. All right, so here we go. One more question for you. We have biweekly pay periods. Biweekly means every 2 weeks. Based on that, how long is a pay period in days? 14 days, right? We've got a 14-day pay period. So let me ask this question. If we have you guys ever heard the old, we had a bad month this month because it was a 3 payroll month? Anybody ever heard that one? Has anybody ever heard we had a good month this month because it was a 2 payroll month? I've never heard that one. I made that one up. I thought I was the originator of that idea. So here's what happens. If we have a 3 payroll month and we're on the cash basis, that means we pay 3 payrolls in, let's assume it's, I don't know, March maybe. We pay 3 payrolls in March. How many calendar days of pay are we paying in March if it's 3 payrolls? 14 plus 14 plus 14 is how many? 42? Did I get that right? I still got it. I can still do math in my head without opening a computer. 42 days. Yeah, you had a bad month because you've got 42 days of payroll, which is, as you may recall, the largest expense on your income statement against 30 days of revenue, right? Yeah, you had a bad month. That's the dark side of cash basis accounting. I can't believe those words just came out of my mouth. When you look at a 2 payroll month, how many days worth of salary are you recording in a 2 payroll month if you're doing it on the cash basis? 14 plus 14 is 28. So I've got 30 days of revenue. How many days of cash, or how many days of payroll expense do I have? 28. All the months are distorted, right? So that's how that's the 3 payroll month phenomenon. You're basically in every month but the 3 payroll month recording 28 days of salary if you're doing it on the cash basis. With accrual basis, you can use that payroll journal to estimate a couple of days of payroll expense at month end and round that out. And on a month when you have 14 days, you're basically pulling, if we, let's say our pay periods end on well, I've got an example here, the 3rd, 17th, and 31st of the month, right? So for the payroll that ends on the 3rd, how many days of that pay period are in the month that are in the current month? 1, 2, 3, right? The 3rd. That means that 11 days are in the prior month. So we basically use the balance sheet to cut that off so that we're only recording 3 days worth of that payroll in this month. And then you've got the 17th, which from the 4th to the 17th is 14 days. They're all in this month. And you've got 18th to the 31st. 17th to the 3rd. I did that wrong. It's actually 13 days, but they're 11. At any rate, you basically use those accrual accounts to get that all trued up. So again, is net income off if you do cash basis bi-weekly payroll? Yeah, it's messed up pretty bad. All right, so cash versus accrual, kind of my 30,000 foot view as it's all over. You match revenue and expenses in the same period. My high gas bill that I had in February is matched with my high Medicare revenue that I had in that month. So you really get a true picture of what happened in that month. Reports financial results more timely. Remember, we get February financial statements in March. So if we record a transaction in February, we see it when we get the February financial statements in March. We record it on the cash basis and we pay it in March. Even though we incurred it in February, we don't see it until April. It's used for Medicare and Medicaid cost reporting, and it's a better measure of financial position. One of the things that I meant to say and didn't is one of the ways you can tell if you've got accrual basis accounting is if you look at your balance sheet, which is the third page in your other packet, and you see accounts receivable and accounts payable. That means if it's payable, that means you haven't paid it yet, right? Therefore, it's not cash basis. If you're keeping up with those transactions on both sides, you basically can tell it at any given point in time how much you owe and how much you are owed. It's harder. It takes more effort to get aspects of accrual basis accounting done correctly. There's a little more effort required. You've got more accounts, some of that. On the cash side, it's pretty easy. Cash in, cash out, it's pretty easy to understand, right? It's simple to prepare. It's the basis that we use for tax reporting, but your net income can be pretty easily distorted. It's easily manipulated. Got a bad month, don't pay a bill. It looks a lot better, right? And the results are shown a month later. All right, questions on cash versus accrual accounting? Okay, let's move on to double entry accounting. This is almost as exciting as cash versus accrual. So when we look at double entry accounting, we basically have debits and we have credits. And for any transaction that we record, the debits and credits have to equal each other. So I want to talk about, that's what we mean when accountants say something balances. It means that the debits and credits equal each other. If you look at your balance sheet, you'll notice that the numbers at the bottom on either side, those are the same number. That balance sheet is in balance, which excites accountants greatly. And the way that you get there is for every transaction, having an entry that's a debit, an entry that's a credit. So there's no great magic to debits and credits. I'm going to teach you an easy way to remember it. But with debits and credits, we talk about a normal balance. And this is something that you're probably best off just memorizing. Okay? When we say a normal balance, we mean an increase. So memorize this. If you increase an asset, it's a debit. If an asset goes up, it's a debit. If an expense goes up, it's a debit. If a liability goes up, it's a credit, meaning a liability has a normal credit balance. If a liability goes up, it's a credit. If a revenue goes up, it's a credit. And it's right there in your notes, or in your on your slide there. Best thing I can tell you to do is memorize it. Okay. So let me ask you this question, and we might do a couple of little examples of this. We have just a minute, but when you look at your bank statement, your personal bank statement, when you have a debit, what are they doing to your bank account? Are they increasing it or decreasing it? They're decreasing it. Didn't I just say that an increase in a cash account is a debit? That doesn't seem right, does it? Which led my ex-wife to tell me on many occasions, accountants are just stupid. And she's not wrong. Think about this. When you have a credit in your bank account, is it an increase or a decrease in your bank account? It's an increase, right? Yeah. But I just told you that an increase in revenue is a credit, right? So the other side of that, if debits have to equal credits, by definition, a decrease in your cash account should be a credit. So it's backwards, right? You know why it's backwards? Because your cash account is a liability to the bank, not an asset. Your cash account is a liability to the bank. They owe you the money, right? A liability is something that someone is something that we owe someone else, they owe you the money that you have in their bank. It's a liability for them. Does a liability have a normal debit balance or a normal credit balance? Credit. When you increase a liability, or a debit, it's a credit. When the bank increases your cash account, is that a debit or a credit? A credit to them, right? So if you have issues with liabilities, or if you have issues with debits and credits, start with the cash impact, right? And whatever your bank says it is, it's the other thing. Whatever your bank says it is, it's the other thing. So if the bank says your cash goes up, that's a credit, we know on our books, it's a debit. If the bank says your cash goes down and that's a debit, on our books, it's a credit. Okay? Everybody got that? Turn the bank on its head. We've all wanted to. Turn the bank on its head. Now, what else did I tell you though about debits and credits? They have to equal for every transaction, right? So what you want to sort of think about is this. Think about any transaction in terms of its cash impact, right? So let's take a revenue, for example. This is going to get, we're sort of building, if we have this concept of turning the bank transaction on its head, and we have the concept of for every credit, there's a debit in the same amount. If you got those two things in your head, you can figure out a lot of stuff. So let's start with something. When we have a revenue, okay, and we're going to assume we're on the cash basis for a minute because it's easier. When we have a revenue, what generally happens to our cash? Does it go up or down? Yeah, it goes up, right? When cash goes up, the bank says that's a credit. So we know it's a debit. Okay, so you've got your debit. Your cash is going to go up. We know we need a credit still, right? Because that's the piece of the equation that's missing. What do you think our credit is? Look at your transaction types or your account types up here. What else? Well, we need a credit. Something's going up. What do you think it is? Revenue. Yeah. Everybody kind of get that? All right, let's try another one. Let's go back to the old utility bill. Let's go back to the gas bill. When you pay a gas bill, what happens to your cash? It goes down. What does the bank say a decrease is? A debit. The bank says it's a debit. So we know on our books it's a credit. So we've got our credit. What do we need? We need a debit, right? What's our debit? Expense account. Yeah. So if I had basically a process, look at a transaction, figure out what it does to your cash. Okay. Figure out how the bank would say that. Does the bank think that's a debit or a credit? Flip it around. And then figure out what the other side is. If you've got a debit, you need a credit. If you've got a credit, you need a debit. So two ways to think about this. The first one is memorize debits and credits. I would do that anyway, commit it to memory. But if you forget, it's the opposite of the bank, and debits have to equal credits. It's as simple as that.
That's pretty neat that you explained it like that. Yeah, I've had a lot of accounting teachers and they've never done it that way.
I was in banking before I was in healthcare. It helps.
Thank you for that. That's
Sure. Do you guys understand that concept? Think we can get there? Kinda? Think through it. Well, I mean, let's do another one just for friends. I might have some in my cell file. The folks, those of you playing along at home won't have this information. Let me see if I can get some here. Okay, here's one other thing we need to think about. So if you thought that look at it from the cash perspective and turn it on its head, that was pretty simple. That's because that's sort of an intermediate step. When you go to an advanced step, it gets a little harder, okay? So the examples we gave were cash basis, right? Everybody with me? Those were cash basis examples. When we're Remember, on the accrual basis, we don't hit cash yet, right? So what I want you to think about is this. Let's go back to that utility bill again. We get the utility bill in at the end of February. We know that we owe it, right? We know that we owe it. What account would we record something that we owe in?
Accounts payable.
Everybody with me on that one? Accounts payable? Yeah, that's an amount that we owe. So does accounts payable have a normal credit balance or a normal debit balance? The liability. Credit, yeah, there are two choices. Right, so it's got a credit balance. It's the same as the cash, right? I mean, if you think about it, we ultimately, kind of look at it that way. So we're going to increase our liability and give it a credit. We're going to increase our expense, right? Because we owe a utility, and that's an increase in an expense is a debit or a credit. When in doubt, just go alphabetically. You'll get it on the second try at the worst. It's a debit. So now we've got a credit and a debit. We've got our expense increased for the amount of the bill, a debit there. We've got a credit that shows we owe that bill. What happens when we pay the bill? Well, our cash goes which way? Down. The bank says a decrease in cash is a debit or a credit. Debit. So we know on our books it's a, right? So we know what our credit is. Now we need a debit, right? Well, we've got that transaction in, it's sitting in accounts payable as a credit, and it's sitting in expense as a debit, right? After we have paid that bill, does our expense double? No. Do we owe it anymore? No. So where's our debit? Accounts payable. Accounts payable goes basically back to zero, right? So if you think about it on the accrual basis, like I said, accounts payable just stands in cash's place. It's getting a little complicated now, and I'm sorry, but I don't know a better way to help teach the concept. Accounts payable basically sits in cash's place for that first transaction. If we were cash basis, we would debit our expense and credit our cash, right? But since we haven't actually spent the cash yet on the accrual basis, instead of cash, we use accounts payable. They're making good progress. Good progress. All right, let's talk about another example here. Accounts receivable. Let's say that we've earned $3,000 worth of revenue from Medicare, right? Ultimately, revenue is going to do what to our cash? If we increase cash, the bank says that's a debit or a credit. Credit. So we know on our books it's a debit. But we're not actually getting the cash yet, are we? We're not getting the cash yet. So, but somebody owes us that cash, right? So what's our account for somebody owes us something? Accounts receivable, right? So instead of debiting cash, we're going to debit accounts receivable. So the balance sheet account subs in for cash. We still need a credit though, right? If I remember right, we need a credit. What's our credit? We've earned revenue. What's our credit? Revenue. Yeah. Revenue's got a normal what kind of balance? Debit or credit? Credit. We've earned revenue, so that's our credit. And then we get the cash in the door, right? All right, so we get $3,000 in the door. We know our cash is going to go up, right? So is that, the bank says that's a debit or a credit? A credit, so we know it's a debit, which means we need a credit. Yep. What do we credit? Well, if you credit the revenue, you've got revenue recorded. You've already credited revenue once. If you credit it again, you're doubled up, right? You got 3,000 twice. Question is, does somebody owe us that money anymore? No, because we got the cash in, right? So we take it out, so we credit accounts receivable. So those balance sheet accounts are in and outs. We basically use those to set up our accrual. The balance sheet accounts are in and out. Maybe something I should have mentioned about 15 minutes ago is if an account has a normal debit balance, that means when you debit that account, it goes up. When you credit that account, it goes down. So debits and credits are opposite. If an account has a normal, so for accounts receivable, if you increase it, it has a normal debit balance, that's a debit. If you decrease it, it's a credit. So it's directional. For liabilities, accounts payable, for example, if we increase it, it's a liability. If you increase it, it's a credit. If you decrease it, it's a debit. So when I say a normal balance, it means what's the balance if you increase it? If you decrease it, it's the other one, the debit or the credit. It has a normal debit balance and that means you increase it, it's a debit. If you decrease the account, then it's a credit. If it has a normal debit balance, if it has a normal credit balance, that means if you increase the account, it's a credit. If you decrease that account, it's a debit. So each account can have both. It's just, is the increase a debit or a credit? And again, probably the best way to remember all of that is, if you only got room in your brain for one little piece of information, it's do what the bank says, do the opposite of what the bank does, and your debits and credits have to balance. If you've got a good memory, memorize that assets and expenses are normal debits, meaning when you increase them, they're debits. Liabilities and revenues have a normal credit balance. If you increase them, they're credits. Remember, the flip side is also true. If you decrease them, if you decrease a liability, it's a debit. If you decrease a revenue, it's a debit. For the most part, your balance sheet accounts go both ways. You have lots of debit, lots of increases and lots of decreases. Your income statement accounts typically only go one way. You'll only record transactions in an expense account that are debits for the most part. It'll be very rare to record a credit. I think that I thought we were behind for a minute, and now I'm looking at it and thinking we actually did 2 semesters of accounting in 80 minutes. It's a new record. So with that, if it's all right with you guys, if this is kind of a natural break in the topics, what I'm going to see if we can do is go ahead and go to lunch and be back here at 12:45. Okay? I don't go anywhere. I'll be around if you have questions.
This conference will now be recorded.
Well, now that we're all experts on the financial statements, let's talk a little bit about how to interpret the information that's in there. Again, we sort of focused on how you get to all of those numbers and what some of the numbers on the financial statements mean. And I think the next thing that we need to spend some time on is how do we interpret that financial information, or how do we determine whether the financial statements say we're doing good or doing not so well? And so that's kind of our next section. Again, this is going to be one of those things where we're going to talk a little bit about how do you interpret or how do you calculate some of these ratios, and this ratio analysis is kind of a financial statement analysis trick. I want to try and spend some time thinking about, as we compute these ratios, what do they really mean and what do they tell us about our organization? The thing I will tell you is it's probably in your best interest to memorize the formulas because some of these things will be on the exam most likely, so memorize the formulas. But what I want to do too is sort of give you an idea of what they're really measuring. So as we go through and look at these ratios, one of the things you'll one of the things that you'll notice is that they are actually, the numbers that are on these are actually the numbers that are on the financial statements that you guys have in your handouts too. So you'll be able to trace back to where those numbers come from. All right, and we're going to start with working capital. And working capital is basically a measure of how much funding you have available, and how much sort of discretionary funding or funding that you can use the way you want to use it available. And the way that we do this is that we take our current assets and we subtract our current liabilities from them. And if your current assets are more than your current liabilities, what you're sort of saying is, I have enough cash and accounts receivable at my disposal that I can pay a certain amount of current liabilities with. And if this number is positive, it means you're in a position where you can meet your current liabilities with the assets that you have. What that means basically is that you're solvent or you're liquid. If your cash, if your current liabilities are more than your current assets, what that means is that you don't have enough available resources to pay the bills that are coming due. And that's not good. So if we look at our balance sheet, which is the third page, I think, in your second set of handouts there, what you see is we have, and I actually pointed this out earlier, I think, we have current assets of $233,300. Everybody see that? That means we've got cash and accounts receivable available. Assets, current assets, remember, are things that are available to us now or in the short term. We have liabilities, current liabilities of $515,200. Those are amounts that we owe in the short term. So we have $233,000 to pay $515,000 worth of obligations, right? That's not good. That is not good. So when you look at your balance sheet for your facility, if your current assets are less than your current liabilities, you got some thinking to do on how are we going to get those things paid. Now, so what working capital is basically expresses that problem in a number. And the number in this case is $281,900. So we've taken our current assets minus our current liabilities, and that's working capital. Current assets of 233, current liabilities of 515 for a net negative number of $282,000. That means we've got $282,000 more of obligations than we have resources available to pay them. Okay. A positive number would be better in case, there's any, I wasn't clear on that. A positive number would be better. Now, there's another way to look at that problem, and that problem is the current ratio. So I don't know, I'm not much of a math guy, which is, I guess, an odd thing maybe for an accountant to say, but I'm really not. But when you see the word ratio, what that means in general is you're going to be dividing something by something else. Ratio means we're going to divide something by something else. So if you see something in your exam that talks about a ratio, remember ratio means you're dividing something by something else. And so you contrast that with the working capital where you're subtracting something from something else. All right, so the current ratio is sort of a measure of coverage on current liabilities. And it's the same, it has the same numeric inputs. But the question we're asking now is, for every dollar of current liability that I have, how many dollars of current assets do I have to satisfy? So if we look at this, we have current assets of $233,000. We have current liabilities of $515,000. And what that means is that for the ratio is 0.45. What that ratio means is for every dollar of current liability that I have 45 cents available to pay it. So it's basically telling you the same thing, just in a different way. And I can't decide which one of those is more depressing. You'd like for this number to be above 1. If that number is above 1, it means that you have enough current assets. Yeah, you've got enough to get there. That's exactly right. Again, higher than 1 means you're liquid. So there we go. Now, a quick ratio almost never gets used. It absolutely, I have never seen this come up in the healthcare industry. So again, some of the ratios and things that are in the financial management piece of your book don't really come up very much. We don't see them. They don't really apply very well to the healthcare industry, but we have to learn them. So here we are. What we're doing with this one is a quick ratio basically is just, instead of using that current assets number, and if you look on your balance sheet, current assets includes cash and accounts receivable and prepaid expenses and inventory. This says basically, we're just going to take cash and the amounts that are due from other people, the accounts receivable, and marketable securities. That means investments, basically. So cash and investments and accounts receivable, and compare just those to your current liabilities. So it's a little more conservative measure. When you think about quick ratio, what we're really saying when you look at our balance sheet here, we can't really use inventory to pay our employees, right? Right? So it's a little more common sense approach to this problem, but it just doesn't really get used all that much. So again, you take your cash and your accounts receivable and your investments, and that gives you what we call our quick assets. Quick assets are basically spendable assets. We can't really spend accounts receivable, but we expect it to turn into cash, in a fairly short window. Again, our current liabilities are 515. So our quick ratio is 0.4. Again, what that means is we have 40 cents of quick assets for every dollar of current liabilities. So still not a good number. There's no way that we calculate this that it looks like this facility is doing very well, right? We're not liquid. Questions on those three? Those are basically 3 ways of measuring essentially the same problem. All right, the next one we're going to deal with is average collection period. And this one's a little bit harder to walk through. But what we're trying to measure is, if we were to say, how much revenue do we earn in our facility in a calendar day? How much revenue do we earn in a calendar day? How many calendar days worth of that revenue is our accounts receivable? Okay, so big picture, take a minute, write down that explanation, because I think that might help you. How much money do we earn, or how much revenue do we earn on a calendar day? And how many of those calendar days worth of revenue do we have sitting in our accounts receivable at any given point in time? So if you think about it from kind of a practical standpoint, let's take the definition off the table for a minute, right? Let's think about this kind of from a practical perspective. If we just have Medicare residents in our building, right? I choose Medicare because it's easy. We bill Medicare, typically most facilities bill that on a monthly basis, right? And let's say that we have just Medicare patients in our building. When we look at that, how many days worth of Medicare revenue should we have outstanding at any given point in time? I think the answer is 30. And the reason I think it's 30 is that we get to the end of the month and we bill that. Maybe the answer isn't 30. Maybe the answer is not more than 30. We get to the end of the month end of April. And we bill at the end of April by May the 10th, and maybe it takes us 20 days to collect. We should have that April 30th, our accounts receivable should be just the services we provided in April, right? If we've got our account, if we are still owed for services that we provided in March, we've got a collection problem, right? So at April 30th, we've got 30 days worth of revenue there, right? We earn whatever we earned that we haven't collected. And if we bill at the end of the month, we've got 30 days worth, right? By the end of that April, by the end of May, we should have collected everything for all of the service we provided in April. So that number related to April should by the end of May be 0, right? But at the end of May, then we provided another month's worth of service. So we've collected at that point. So we've got a full month's worth. So from a practical standpoint, what I think we've just said is for our Medicare revenue, we shouldn't have more than 30 days worth. Now, let's think about how things work in Oklahoma. How often, for those of you who may be involved in the billing process, how often do we bill Medicaid? Weekly? Yeah, lots of facilities in Oklahoma do weekly. All right. So at the end, if we have just Medicaid residents in our building, everybody okay with that? If we have just Medicaid residents in our building, at the end of April, how many days worth of revenue should we have outstanding? Yeah, 7 if they turn it around in 7 days, right? Yeah, so you might have 2 weeks worth outstanding, but it should never be more than 30, right? Yeah, I think you're exactly right. So, we've got that last week of April's worth, and if we haven't gotten paid for the second to the last week of April, that might be outstanding just because it takes them 10 business days to process, right? Give or take, or does it process on the following? There's a weird deal where it processes on everything that's in this Wednesday gets processed the following Wednesday. Something like, I can't ever remember how that works. I don't bill. So yeah, you're exactly right. If we bill Wednesday to Wednesday, it's 7 days.
So we are saying that if we bill hypothetically this Wednesday, we expect to get an income to get thrown back into the building in a week or 10 days?
Yeah, should be. That's right. If you're submitting clean claims, you should be. So right now we've got Medicare at 30 days, right? What I'm trying to get to is, once we do the math on this, how do we know if it's a good number or not, right? So we've got Medicare at 30 days. We've got Medicaid at, let's call it 7. Talk about private pay for a minute. How much should we be owed for private pay at any given point in time? When do the private pay patients pay? After the service is provided or before?
Usually after.
Before. They pay like rent, right? They pay the first of the month, not 15 days after the 30th of the month, right?
I just know when we do an admission, we don't wait till after they've been there. They don't come in and pay us.
On the nursing home side, they typically do pay. They pay.
And then it's refunded.
Yours are going to be the vendor pay. So you're getting yours out of Social Security. For a pure private pay, they pay like rent. It's on the first of the month.
Because it'll just be refunded if they die or.
Yeah, we might make adjustment for beauty shop charges or medical supplies or meals or something like that. Yeah. So stipulating that we pay like rent, how much should we have? How much should our private pay patients owe us at any given point in time? Nothing. So our accounts receivable, or our days in accounts receivable, our calendar days of revenue and accounts receivable for private pay should be 0. We just said Medicaid is 7. We said Medicare is 30. What's a good number? Less than 30, right? To start, how about less than 30? All right, so let's see how we're doing. So what we're basically saying is, remember, this ratio is calculating calendar days worth of revenue, and how many of those calendar days worth of revenue is sitting in accounts receivable. Okay? Sitting meaning, not sitting's a bad word, but that's the term that we use. So we start with calculating calendar days revenue. This income statement, I think, was for a 365-day period, right? All right. And we had that much revenue. So if you take that revenue divided by 365, we have average revenue of 7,613. If you have a printed copy of this, scratch out that PPD that's on there that should say calendar day. Not PPD, my apologies. If you can't tell, I'm a little scattered. So we said basically every calendar day, this facility earns $7,613. Every calendar day. Kind of on average. Two things are important there. First is that it's a calendar day, but we need to make sure that when we look at this revenue number, whatever number of calendar days that revenue number relates to has to be that number. So if we were looking at this, if we only had 6 months of data, for example, if that number were for the 6 months ended December 31st, 2019, we'd use 180 there. I don't think they're going to throw you that curve, but generally that number of days has to be the calendar days that revenue number on top was earned. Okay, I just don't want us to get hung up on that. All right, so then we take our accounts receivable, 134.2, that's what people owe us, right? And we divide it by 7,613, which is our average revenue per calendar day. And again, you might change it there so you don't get confused. And I'm sorry I confused that. When we divide that out, it's 18 days, 17.63 days. Is that good or bad?
It's okay.
It's less than 30.
It's less than 30. That's right. So let me ask you this question. If I have all Medicare patients, is 17.63 a good number?
Yeah.
Yep, it's real good. It's real good. I'm on fire. If I have all private pay patients, that's a really bad number, right? And if I've got all Medicaid patients, not the end of the world. It's probably not great. It's probably not too bad. It's probably about, maybe a little less. Somebody's going to be screaming the cash isn't coming in quick enough, but it's not by much. So when you look at this, you have to kind of keep in mind what we call payer mix. How many patients do I have that are Medicare? How many do I have that are Medicaid? How many do I have that are private pay? If we have a building where where those revenue streams are about equal, this isn't too bad. We see a lot of them in the 40s, 50s, and 60s. So then the question that you have to ask is, why, right? And the why is actually more complicated than you think. Is it because we're not getting the bills out the door? Is it because, in other words, is it an issue of us not getting cash in quickly enough? Or is it an issue of us not posting payments correctly and that accounts receivable is continuing to balloon up? Yeah. Okay, so that's average collection period. And we did that already. All right, average payment period kind of works the same way. Average collection period, you're basically saying, how well am I doing at getting my bills collected? Because my employees won't wait till you collect the bill to get their payroll, right? They're funny like that. Average payment period is the same thing, but for how quickly we're paying our vendors. So while average, the day's revenue and accounts receivable, the previous one is a measure of our performance in billing. This is really a measure, again, of liquidity. How well are we doing at getting our vendors paid? So it's a measure of lag between vendor services rendered or goods received and the payments made. This ratio you want to be lower, just like the other one. The reason you want it to be lower is that your vendors will be happier if it's lower. And assuming you care a great deal about your vendors' happiness. Right? So what we look at though is when we think about this, this is measuring accounts payable, right? Accounts payable are amounts that we owe our vendors. So whereas the previous ratio we used average revenue per calendar day, in this one, what we're trying to compute is average vendor expense per calendar. Average vendor expense per calendar day. Well, our total expenses are $2.8 million, but we need to exclude salaries and benefits because our employee payments aren't included. Our employees aren't vendors, right? Right. Our employees aren't in this accounts payable. So we're matching things up as best we can. So we take our total expenses and back away salaries and benefits, and that gives us our non-salary expenses. It's pretty close to our vendor expenses. We compute our days in the period, and again, it's a 365-day period, and we get our average daily non-salary expense. Our accounts payable is $256,000, so we divide how much we owe those vendors by how many calendar days worth of expense, by our calendar expense per calendar, our non-salary expense per calendar day, the number we just computed here, and that gives us a number of days. And what this is saying is we have 75 days of vendor expense that's outstanding. Are our vendors happy campers? They are not. What should that number be? 30 at the outside, right? Yeah. So again, as we've looked at this facility, we've said our current assets are pretty low relative to our current liabilities. In fact, we've got twice as much current liability as we have current asset. Everybody remember that from the first 3 slides we talked about? This is telling the same story. We're slow to pay our vendors, and we've got a liquidity problem. It's only a matter of time before the Cisco truck doesn't show up. Okay, questions on those ratios. Those are the ones that relate to our balance sheet. And we'll come back around to a couple of more that are on the balance sheet later on. All right, we're going to spend a little time with our income statement, which is should be the 4th page in your numbers supplement. Net operating margin is basically a measure of, for every dollar we earn, how many pennies are we getting to keep, right? Or of the money that we earn, what percentage do we get to retain? Well, in this case, if you look at your income statement, you've got $593 of net income. That's that number all the way down at the bottom, right? We have got total revenue of $2,781,300. So if you take that $593 and divide that by your $2.7 million of revenue, you get 0.02%. That's our net operating margin. So for all of that stuff, all of the stuff that we do and all of the care we provide, at the end of the day, we're keeping 0.02%, 0.02 of a penny for every dollar we bring in the door. That is not good. Also not good. We would like to see that number be higher, and I want to make a couple of comments. I may come across as a little bit crass about profitability, but you know, I've heard a number of organizations, whether they are for-profit organizations or not-for-profit organizations, that sort of look at this and say, if we don't have a margin, you ever heard the saying, no margin, no mission? This is what we're saying. By margin, we mean net income. If we don't have a margin, we can't afford to pay for raises. We can't afford to invest in our facilities. We can't afford to change the way we practice. We can't afford, if we're a mission-driven organization without profit, we can't improve things for our residents. We just can't. If you spend every dollar you make today on the residents today, you're ensuring a static future for yourself. You're not going to get anywhere. So don't ever let anybody tell you that a margin is in some way a bad thing. Margins are how we fund raises, how we fund, I did say that right, how we fund raises, how we invest in capital, how we come up with the dollars to pay our share of a facility renovation, how we invest in training programs, how we improve our care. Margin's really important. All right, we're going to jump back to in this one, the debt to equity ratio, again, very rarely comes up in the nursing home biz. But if you are getting ready to finance something, this is the calculation that the banks will do. And what they basically say is it's a measure of leverage. In other words, of your equity, how much of it is really owed to a bank? So whereas equity overall is, it's your net assets, it's your assets minus all of your liabilities. This is just saying of your equity, how much of it is bank related, how leveraged are you? In this case, our long-term debt is $320,000. Our members' equity, our overall equity in the facility is $23,000. So our debt equity ratio is 13 to 1, 14 to 1, meaning that for every dollar of equity, we've got $14 of debt. Is that good or bad? Maybe. If you're trying to borrow, it's definitely bad, right? But think about this. When you think about what equity is, over time, equity is the accumulation of our earnings, right? So if you look at how you build equity in an organization, first of all, you have to have positive net income over time, right? So if you build that positive net income up over time, your equity grows. But what happens if our owners are accustomed to taking large distributions of that equity? So they may say, if this building earns $300,000 this year, as my compensation for the risk of owning this building, I'm going to take $250,000 of that out as return on my investment. My equity doesn't really grow as much over time. And again, this one is just not comparable because some facilities are mortgaged, some are leased from unrelated organizations. So this one is just all over the board. But again, it's a ratio that we only really see used. It's computed by banks in such a way that it's a limited. I guess I'd say it's a limited use ratio. It's really not used for operating purposes. It's really used more for banking. Questions on those ratios? Let's look at some other ratios and formulas. We've got a couple of ratios that we use actually quite a bit. One of them is our average daily census, which is basically trying to say for over a period of time, how many residents do we have on average in our building? Okay, so what you do with that is you take your patient days. Does everybody know? A patient day is basically a patient that's in your facility for a day. Heads in beds at midnight is one way to look at it, right? If we have a patient in our facility at midnight, One midnight is one patient day. If we have a patient day and if we have a patient or resident in our facility for 31 days, that's 31 patient days. If we have 2 residents in our facility for 31 days, that's 62 patient days, 31 plus 31. Yeah, so that's a patient day. So when we look at our average daily census, we basically say, how many patient days did we have divided by how many days are there in the period that we had those patient days in, right? What that gives you is an average number of residents in your facility at any given time. So an average daily census. You can look at that differently and look at it in terms of occupancy percentage. And the way that you compute an occupancy percentage is you take that average daily census. So how many patients on average do we have in our building? Let's say that number is 80. And divide that by your licensed beds. Let's say we have 100 licensed beds, and on average we have 80 patients. Our occupancy percentage is 80%, 80 divided by 100. So there you go. Average length of stay is another one that we look at. I will tell you that the average length of stay that gets computed on your Medicare cost reports is wrong. It's just not right. The average length of stay is basically your patient days divided by your admissions for a period. It's probably only meaningful for Medicare because your Medicare patients don't stay as long. But your average length of stay, again, patient days divided by your admissions for a period. So what that's measuring is, on average, how long does a resident stay in our building? And the final one that we look at is full-time equivalence. And the full-time equivalence is hours worked divided by 8 hours per workday. So if we look at that on an annual basis, we have 52 weeks, 40 hours a week in a 5-day week. That's your 8 hours a day. It's 2,080 hours is sort of what it winds up being. So if you take your hours divided by the actual hours that you incurred divided by 2,080, that's your FTEs or full-time equivalents. So if we have an RN that works 2,080 hours, we have a second RN that works, I don't know, 1,040 hours, and 2 more that work 520 hours. You add those all up together, you get 4,160 hours. You've got 4 RNs that are working that, but they amount to 2 FTEs, 4,160 divided by 2,080. So it's basically, what it sort of does is level the field for your part-time employees. Your staffing model may be that you use half part-time employees. Your staffing model may be that you don't ever use, make minimal use of part-time employees. If you want to compare, though, you look at it in terms of FTEs, and that's really your benchmark, because that takes the number of bodies out of it. It just looks at the hours that get worked. You guys okay with that? I went through it pretty quick. Patient days, or the per patient day amounts, are really kind of a common way that we measure a lot of our stuff. We may compute our staffing ratios on a per patient day basis. We may look at our dietary costs on a per patient day basis. We may do budgeting on a per patient day basis. So there's a lot of use of these per patient day amounts. Costs per patient day. Again, and really looking at it, remember we talked about your chart of accounts and how the accounts need to be at a level that you can use it to manage with. Remember the whole, you don't really need an account for fabric softener deal. That's what we're talking about. So if you look at costs, the costs you want to manage, you're probably looking at them on a per patient day basis. And all you really do is take the costs and divide it by the patient days in that period. And I want to emphasize again that the periods need to match. It needs to be the same number of the patient days need to be for the same period as the cost is. If you're looking at it on an annual basis, make sure you're looking at a year's worth of days. If you're looking at it on a monthly basis, make sure you're looking at a month's worth of days. Does that make sense? So comparing a month's worth of patient days. And it's fairly common to look at this. You know, we look at in dietary costs per patient day, we look at medical supply costs per patient day. We look at a lot of things like that, where patient days actually impact how much of those things we would use. We would expect that if our patient days go up, our dietary costs would go up. We would expect that if our patient days go down, our food costs would go down. So it's sort of a way of keeping an eye on those. I'll talk about variable costs in a minute, but it's a way of keeping an eye on those costs, making sure that the costs that should change with our census actually do change with our census. That's why we use PPD so much. The other thing we look at is staff hours per patient day. I'll tell you, in Oklahoma, the average direct care staff hours per patient day, that's RNs, LPNs, CMAs and CNAs, restorative aides if you've got them, and the director of nursing. You add all of those clinical direct care positions together, on average, our hours are 3.62, I think, 3.62 hours per patient day. If we're looking at, everybody remembers that salary is the biggest expense on our income statement, right? Guess what the biggest piece of that biggest expense is? RNs, LPNs, CMAs, CNAs, restorative aides, your DON, so the direct care staff. That's the biggest piece of it. If you want to manage that piece well, watch that staff hours per patient day number and look at where it is. If you haven't gone out and looked at Nursing Home Compare for your facility to compare hours reported to hours expected, that hours reported to hours expected, those are expressed in terms of hours per patient day. And what they've done is they've said, based on the information that you have included in your MDS for all of your patients, right? This is the expected RN, LPN, and aide hours that you should have for this building. Now, that expectation is based on time and motion studies that were done in 1995 and 1996, so before all of you guys were born. So they're a little outdated, but they're still a pretty good benchmark. And it's amazing how many facilities sort of naturally staff to those levels. So it's an acuity adjusted benchmark. Seriously though, if you haven't gone out to Nursing Home Compare and looked at your expected versus actual staffing levels, RNs, there's a separate column, a separate total for RNs, for LPNs, for aides. The RNs and LPNs are combined for one total. So if you want to look at the overall nurses versus aides complement, and then there's a total there too. It's good information and it's credible. It comes from your PVJ reports, which are about as granular as you can get, right? Because we're inputting information by staff person by calendar day. I mean, it doesn't get a lot more granular than that. So look at that. And then revenue per patient day. I'll tell you, one of the things we did, we did this math for a client of ours a bunch of years ago. And we said, we know that our private pay rate is $150 a day. We know that our Medicaid rate is $140 a day or something like that. And we know how many patient days you had during the period, right? So we added that up and said, if I take this many patient days for Medicaid and this Medicaid rate, and this many patient days for private pay, and this is your private pay rate, that ought to be what our revenue is for that period, right? I mean, that's how the math works. It's units times price. We looked at their income statement and their income was $80,000 short of that. And we thought, well, you know, maybe they had something come in late, or, you know, there's a cash collection issue or an adjustment or something squirrely, something got put in the wrong account. But we pushed back on it and said, I don't understand why your income, your revenue is $80,000 short of this number. The reason their income was short by that amount is that fortunately or unfortunately, their biller resigned, had recently resigned. They opened the bottom right-hand desk drawer, and guess what they found? ADRs, $80,000 worth, additional documentation requests from Medicare or from Medicaid that had not been responded to. And we found it because we computed average revenue per patient day. But none of those computations in a vacuum really mean anything. You have to have something to sort of benchmark. So, keep an eye on that stuff. It does happen. All right, that concludes the ratio analysis piece of what we do. Are there questions on that? Again, the best advice I have is memorize the formulas, but to the extent that you can sort of make sense of them, try to understand what each formula is trying to do for you. To the extent you can make sense of them, it sort of gives you an edge in addition to the memorization. So there we are. All right, let's talk about how accounting works. We're going to start with billing and collecting. So I would say in terms of the financial management piece of what we do, if you're going to spend time in the accounting area, spend your time in billing and collecting. I'm not saying you should bill and collect, but I'm saying you should be very friendly with the people that do your billing and collecting, because they're the banker. I mean, they're where the cash comes from. You've got to manage and monitor and keep an eye on that very, very closely. Understand the processes, understand the procedures. If you're going to spend time holding somebody accountable, it's these guys. There are some great ones out there, but Medicare billing, Medicaid billing, it's a complex issue. It doesn't do you a lot of good to provide a bunch of service to our residents and at the end not be able to convert that to cash. And that's what billing is charged with, is converting the service you provided into cash, because you can't spend accounts receivable. You can spend cash. Your staff are not going to wait to get paid until you get around to collecting. The other thing I can tell you as both a consultant and as a family member of people who have consumed long-term care services or nursing facility services is, if we don't do our billing well, we can delay cash receipts. We can delay the cash coming in, which does not make our vendors happy, because ultimately they're the ones that get held off. If you don't bill well, you can cause the facility to not get paid at all. If you can't submit a clean claim timely, there are timely filing limits on our claims, meaning that if you don't file by those timely filing limits, you just don't get paid. Sorry. If you don't file a clean claim, they can also either delay or cause you to not get paid at all. And you have to be following up on that. These things can land you in jail. I've heard our firm bills for about 80 nursing homes, Medicare and managed care billing. And I've heard in presentations that I've done with the director of our billing service, she says some of the most terrifying things I've ever heard. One of them is, you can do everything right in your patient care and documentation process. Everything right. The documentation, the claim can be, the charges that you put on the claim can be fully supported by the medical record. The MDS can be absolutely perfect, capture all of the patient's conditions and comorbidities and changes in functional status and all that good stuff. Every one of it, you can do the whole thing right. You can get the bills in from your rehab company, from your pharmacy company, from your diagnostic lab and radiology companies. You can get those absolutely correctly on the bill and entered in your system absolutely correctly. It can be perfect. And for some reason, the claim doesn't go through. And the biller decides that, well, I checked this box on the last claim and it went through, so I'm going to check this box on this claim, and it's going to go through too. At that point, you've that point, you've committed fraud. Assuming that box is incorrectly checked, of course. You can do a lot of things right, and bad billing can just mess the whole thing up for you. So pay attention to it. You have to have a fairly high degree of confidence in your biller. But even if you do, ask some good questions. Learn how some of that works. Invest your time in it. And again, as a consumer, I'll tell you that if I get contacted to pay a bill that I've already paid, or I get contacted because to pay my May bill, when I paid my May bill and they actually wound up instead posting my May payment to my July bill for whatever reason, I'm not going to be real happy about that. So there's a lot tied up in billing. And I think it's your first priority. I mean, it really is. So how do we make sure we get paid? I mean, there's a lot of technical junk in the billing process, and I'm not going to get into it. The reason I'm not going to get into it is I don't understand all. But I can tell you that there are some processes that you need. One of them is document the resident's payment source. When they come in the building, when they're signing the admission documents, document the payer source. And by the way, don't just document it, verify it. One of the things that we see quite a bit is a patient will come in with a traditional Medicare card, right? Somewhere along the way, so you say, oh, they're traditional Medicare, and you start providing service, comes time to bill, turns out they bought a Medicare Advantage policy and they switched over. But that's not the card that was in front in their wallet. The time to know that isn't when you're trying to get a bill out the door. The time to know that's on admission. So don't just document it, but call and verify. A lot of our accounting systems, our billing systems now actually have the ability to have you upload that information, and they will actually verify that with the clearinghouse. If it's not the right payment, get the right payment source. I think the second thing is to get in a rut. Billing process, it's a good idea to have that be a fairly routine, and I'm going to say rigid process. Our goal is to bill by the 10th of the month following the end of the service period that we've provided. That means that I have to have my bills from the therapy companies by the 4th of the month. I have to have my diagnostic bills from the hospitals or mobile x-ray or whoever, regional medical lab, whatever we're using, have to have those by the 4th or 5th of the month. I have to have my bills from the pharmacy company uploaded by the 4th or the 5th of the month. Once I've got all that information, then we go through a triple check process where we basically say, these are the services that I have bills for. Is the need for those services supported in the medical record? Do I have signed physician orders? All of that stuff. So if you think about this, if we ever get a bill, and I'm not saying the 10th of the month is the right number, it just seems to be a common number that we see. If that 10-day window is going to get met and the bills that go out are going to be compliant, a lot of things have to fall in place pretty quickly, and that leads you to think about a process. So, what's our process for making sure that all of those things fall into place? I mean, I think the other thing that you look at is if you have private pay residents, again, they typically pay before the end of the month, for the next month. So they pay before the 1st of the month for the month that they're going to be involved with, that they're going to be staying with you. And that's for pure private pay. Again, the ones where it's a vendor payment or a Medicaid coinsurance, they're going to wait until the Social Security check processes to pay. But for those guys, for the folks that pay at the 1st of the month, put yourself in a position where you can collect more timely. If you have special charges like guest meals or beauty shop or any of those things, how do we collect in our facility? How do we collect the information? What's our process for gathering information on those if we do in fact charge for them? Probably not a bad idea to try and get those on the bill before the end of the month, before the resident or the resident's family comes in to make the payment. That accelerates your payment by 30 days. And they're little Mickey Mouse amounts, but my profit margin is 0.02%. I need all the Mickey Mouse amounts I can get, right? Again, Medicaid, weekly, semi-monthly, monthly, whatever that process is, get that process and timing so it's understood, and the people who have to contribute to that process understand they have to contribute to it. Another piece of that is our refunds. Like I think it was you mentioned earlier that if we have a resident that pays at the first of the month and they expire during the month, we have a refund that we have to refund part of that. What's our process for processing those refunds and getting those paid in a timely manner? I think the second thing we have to keep in mind is, so collecting starts with getting a good bill out and getting a good bill out timely, right? The second piece then is what do we do with that bill if it doesn't get paid through the routine process? Medicaid doesn't process, Medicare doesn't process, the family doesn't pay. And I think it's increasingly firm statements or collection letters every 30 days until that bill gets paid. That's kind of the expectation. In fact, as we've talked to Novitas, who's the Medicare administrative contractor for Oklahoma, one of the things that they've said is we expect to see facilities collection processes for all types of patients be billed just like your credit card bill or your utility bill. They expect it to be a fairly rigid, we send our follow-up bills on the 3rd, 4th, 5th of the month, whatever it is, or 15th or whatever it is. And we expect there to be at least 3 billing cycles. So a bill, 30 days later, if we haven't collected it, a statement or a follow-up notice. 30 days after that, if we still haven't collected, another letter that probably has increasingly firm language. Following that, another 30 days. And then leaving that bill open for at least 30 days after that third letter goes out, because you have to have time for the person to actually pay. So at a minimum, sort of a 120-day window from the date the resident gets billed to the date that you decide maybe it's not collected. That's the minimum expectation for the industry. But I wouldn't say in this day and age that we let the letter be our only communication, right? Now, don't get me started. These kids today, right? These kids today want to do all of their communications by email, and email is actually outdated, right? My children think I'm hopelessly old and useless, and they're probably right in some respects. But we want to communicate with email. We want to communicate with text or other things like that. But I will tell you, even as young as I am, it gets my attention when somebody picks up the phone and calls me. If I have to talk to a person about why I haven't paid my bill, that gets my attention. It's a lot easier to delete an email. So looking at when you say I made a follow-up attempt, tell me what a follow-up attempt means. Does that mean you sent an email? Does that mean you picked up the phone and called and left a message? What does that mean? Pick up the phone. It's just, again, it makes me seem hopelessly old, but it works. And I like my cash. Big fan of cash. The other thing I think you have to do is document your communications. So I made a phone that most of the billing systems we have these days actually have places to document your communications, right? So document what we did. I called and left a message. I called and made contact, and here's what they told me. They told me they're going to pay by the 3rd of next month. Guess what goes on my calendar as the collector? Watch for a payment on the 3rd of the month, right? There's especially for newer residents, there's sometimes a little bit of a training process. If you get put off, yeah, I'll pay you in 2 weeks. The payment doesn't show up in 2 weeks. You're on the phone saying, hey, I thought the payment was going to be here today. Right? We were expecting that. Is there a problem? Did you maybe forget to put a stamp on the envelope or whatever? Making those types of conversations and calls trains people that you're not going to get away with not paying for the service. So those sorts of things. And again, I think documenting our procedures and following. One of the reasons that we have collection procedures that we have is that it gives your collecting person, your biller, something to hide behind. It's not me being me, it's just our policy, right? Put those policies in place, basically just sort of list as I've listed out here, to make sure that your job is to hold your people accountable for following them, and make sure that they feel free to hide behind those policies. Okay. What gets measured gets done. So here's, if I'm an administrator, here's what I'm going to look at. First thing is reconciling monthly census with days billed. Remember, we talked early on in this about the billing journal, which is where you record as you bill or as you provide a service. We've got information in our facilities about what our census is, what our census count is. Reconciling the days billed to the days of service provided is a big deal. Spend a little time to do that. Just do it every month. Review your receivables or logs for unpaid invoices. In fact, there's this really neat report that you can get out of most billing systems called an accounts receivable aging. And what this report does is it lists each of your residents, right? And it lists their amount due. And it says, was this amount billed 30 days ago, 60 days ago, 90 days ago, 120 days ago, right? You can look at that report and just sort of focus on the stuff that was billed within the last 30 days. That's, you might ask the question, based on what we just billed out, do we have anything that we're worried about? I think I just let the conversation stop there. But when you get to 31, to an amount that's more than 30 days old, now we start asking questions. Have you made contact? What did they tell you? And I will tell you that having that 15-minute conversation with your biller will change that biller's performance, because what you're doing with that is setting an expectation. I want to see the accounts receivable aging. As soon as you've got your Medicare billing done, we're going to sit down on the 15th of the month or whatever it is, and we're going to go through that aging together. And you're going to bring me a copy, and you're going to have a copy, and I'm going to take notes on my copy. And guess what? Next month, when we do it again, guess what I'm going to have on my desk? My copy from last month that has my notes on it. Now, we thought we might be able to file a lien on this, whatever. Talk through that. Did those things get done? So it's about discipline, really. And you're looking for patterns too, status of old claims. If we've sent something out for 120 days, it gets into that 120-day column. At some point, you've got to look at that and say, am I really going to collect this? And if you're not, write it off. If you're not going to collect it, write it off. You don't need the distraction, right? We've got plenty of other claims to work. Okay. All right, we're an hour in, and the hour after lunch is usually a miserable hour. So what I'm going to do is ask that we take about a 15-minute break, and we'll start right back up at 2 o'clock, and let's try from 2 to 3:45 to get you out of here.
This conference will now be recorded.
Ready? Okay. So we talked about billing procedures, and that's really the most involved one, and it's really the one where you're going to spend the most time. I want to talk about some of the other processes as well, though, just so you probably do already, but I just want to make sure, just so you sort of understand the documents that are involved in those processes and how those are to be used, because sometimes I think we see the documents and don't really entirely understand what we're supposed to use them for, what they're really supposed to accomplish. So we're going to start with vendor and employee payments. And The process works a little bit like this. We start with a purchase order. So we identify something that we need, or there may be routine purchase orders that we use for, you know, over-the-counter drugs, or sort of our base stores, our base supplies, or even, you know, food processes or whatever. But the department that sort of figures out what they need documents that on a purchase order. So they basically say, here are the things that I want to buy from this vendor. The process from there may vary from facility to facility. For example, again, if it's a food order, your dietary manager may have the authority to go ahead and place that food order and place that food order directly with the vendor. But if it's a non-routine sort of order, of some sort, it may be that the purchase order gets prepared and then brought to you to review. The whole point of the purchase order is to document your approval that it's okay to buy this stuff. Okay, that's the sole purpose of a PO, to just document that it's okay to buy what you've decided to buy, and have the documentation that it's okay. So we send that purchase order off to our vendor, or we fill out something online, or however our ordering process might work. And I'll be darned if one of these days a truckload of stuff doesn't show up at our facility. And when it does, the first thing, what we're going to be handed by, what will be in the box, or what will be handed to us by the delivery service, will be a packing list or a receiving report. And what that receiving report does is it says, these are the things that we're bringing to you, right? This is what's on the truck. So you take that receiving report, part of your process then is you take that receiving report and you say, you know, I'm supposed to have 3 cases of Ensure. Do I have 3 cases of Ensure? Yes, I have 3 cases of Ensure. Check. Going through that process and making sure that what's on the receiving report is what we actually received. Now, there's another piece of that process that you probably ought to do, and that is compare the receiving report to the purchase order. Why would you want to do that? Yeah, if I'm going to pay for it, I would like to have ordered it in the first place, right? So checking that purchase order, remember that's documentation that this is what we approved to be received, or approved to order, comparing that to the receiving report to say, did we get something that we shouldn't have gotten? That's the best time to do that comparison, because you can send it back on the truck, right? So your next process then is that you take that receiving report and that gets filed in the business office manager's office, or whatever your process is, but it gets filed. Lo and behold, a couple of weeks later, or a week later, or a day later, an invoice shows up. And what that invoice says is, we would like for you to pay for this, for the stuff that's on this list. Well, the first thing we want to do, we want to do 2 things at that point. The first thing we want to do is basically compare that invoice to the receiving report. I don't want to pay for something that I didn't get. So is every item on this receiving report also on my purchase, or on my invoice? Is every item on my invoice also on the purchasing order? Is everything on my invoice on the receiving report? Is everything on my invoice on the receiving report? Answering the question, am I being asked to pay only for things that I actually received? Your next process, if you don't have a process of comparing your receiving report to your purchase order, is to compare your invoice to your purchasing order, right? Again, am I being asked to pay for something that I didn't want? Even if I got it, if I didn't want it, am I being asked to pay for it? Once you've got that process put in place, we look at that invoice and we say, this is approved for payment. What you do at that point is you enter it in your accounting system. It goes into your vendor payment system. Regardless of when it's due, you enter it as soon as it's approved in your system, because that's documentation that you owe somebody, right? So we want that documentation in our system as quickly as we can get it. Now, down the road, we may decide to, we hopefully at some point, we'll do what we call a check run, which is where we basically select a bunch of payments that are in our system or a bunch of invoices that are in our system and check those to be paid. Once we've done that, then those come back out of our payment system. But by keeping those invoices entered in our system all the time, as timely as we can, that lets us keep an eye on what we owe. So getting that done timely is important. Don't let that get behind. In a lot of cases, those things are actually automatically uploaded these days, and if they are, the automatic system mirrors the kind of a manual paper system. It's the same concept, making sure that your invoice matches your receiving report, making sure that your invoice matches your purchase order. So what happens if we don't pay quickly enough for the vendor? They send us a statement. And a statement is basically a summary of the invoices that the vendor thinks haven't been paid yet. Here's a cardinal rule for you. Don't ever, ever, ever pay from a statement. Never, ever pay from a statement. Only pay from invoices. The only thing a statement is good for, other than to irritate you if you've already sent the check, is to be able to reconcile. This statement says these 4 invoices are outstanding, right? So what I might do is pull up my vendor file or my computer system, my accounts payable system, and look in there and see, well, I showed these 4 invoices are also outstanding. So we agree. Good information, great. They'll come out on the next pay cycle. Or to be able to say, I only show 3 of these outstanding. One of them probably I sent a check for, so it probably crossed in the mail. They sent the statement the same day I sent the check, so it shows it's outstanding. So it's a good reconciling tool, but really, you don't pay from it. It's just a way to check your systems. Let's talk a little bit about inventory. When we have a delivery, it should be received. That delivery should be received in a storeroom or a receiving area, or if it's food in the kitchen, it should be received right in the area where it's going to be, where it's going to wind up being inventoried or stored. And it should be immediately reconciled to the receiving reports. We're still big fans of storerooms being locked to prevent shrinkage. Shrinkage means theft, right? So keeping anything of any value sort of locked down. I'll also tell you that we still think it's a pretty darn good idea to count your inventory periodically. So if you keep stores of food or stores of medical supplies, even linens or something of that nature, it's probably not a bad idea to do a periodic count. Accounting standards would tell you that you ought to reconcile that to the inventory account on your books. I don't get too wound up about that piece of it, but if you count your inventory periodically, it looks like you're keeping an eye on it, and that leads to less shrinkage. So it's sort of what I'm going to call a psychological control, if you will, right? So doing those counts periodically. The other thing that does is let you look at the inventory you've got and get rid of anything in there that is old and outdated or not usable or past its expiration date. So being able to clean all of that stuff up, but I think that's part of the process too. We really want to avoid, and as the delivery systems have evolved and gotten better, we're not seeing people carry as much inventory these days, because what happens is if you carry a lot of inventory, you've got a lot of cash tied up in something that you're just storing. The delivery systems we see now, people are getting their supplies that they're going to use very close to the time that they're going to use them. So over time, those stocks have really decreased. And if they're not sitting there in a closet, guess what? Shrinkage doesn't occur if they're not there, at least not on your watch. I mean, we've all heard these stories. My gosh, I have a client over in Arkansas that is just a kind of a wild character. And he was talking about one of the nursing homes that he owns. It was well known in the community that this nursing home was in, that there was a fresh chicken sale in the back parking lot of the nursing home, like every Tuesday. So the dietary manager would order excess meat product and sell it off, sell it out the back door of the nursing home for personal gain. Yeah, this stuff happens. The Tuesday chicken sale, anyway. You can't make this stuff up. The best way to prevent that from happening is not to keep very much of it on stock, much of it in stock. All right. Let's talk about payroll for a minute. And we covered this a little bit, a couple of minutes, very, very early on when we talked about the payroll journal. A lot of us these days have our payrolls processed by ADP or Paycom or Paychecks, or Southwest Payroll is a good one. Several of those payroll services that are out there that all they do is process payroll. Frankly, I think payroll is a complicated enough process that I would never dream of doing it myself, just because the tax tables have to get updated, the levels for deductions get updated on an annual basis, all of that. So if your facility is not using one of those services, it's probably worth it just from a pure risk perspective. And they're not terribly expensive. A lot of times they'll actually furnish you with the program, they'll furnish you with the time clocks, the whole 9 yards. So it's worth looking into. But if you think about what goes, I mean, just think about your own paycheck for a minute. You've got your gross pay, right? Which is basically, if you're an hourly person, that's basically your hours times some rate. You might have overtime, which is those excess overtime hours times, a time and a half rate. You may have a holiday differential if you work a holiday. You may have a shift differential if you work a shift that you're not accustomed or normally working. You might have vacation. If you have PTO in your facility, you may have vacation that needs to be tracked, so you know how much of that vacation you have. That's an amount that's due to your employees. It's a liability. Whether you participate in your health insurance as an individual or as a family or as employee and spouse, or however you do that, that's a data element. Does the facility buy uniforms and deduct uniform expense from your pay? Do you participate if your facility, and not many do these days, but if your facility has a 401k or some sort of retirement plan, do you participate in that? All of those things are data elements that are in your that should be in your facility's payroll system about you. And those are all crucial data elements to get your payroll correct. So keeping an eye on that stuff, making sure that the data that's in your payroll system is good data, that it's correct data. It's a pretty important thing. So all of that stuff goes in there. You've also got productive hours. So, our employees clock in, they clock out. Sometimes they forget to clock in and still clock out. Sometimes they clock in and forget to clock out. All of that stuff goes into our productive hours. We also have non-productive hours, which are our, if we receive holiday pay for not working, if we receive time off for holidays, that's an element of it as well. So when you look at it, those are sort of your components. You set up those rates and deductions in your payroll system. You accumulate those hours by time card or a time sheet, typically time clock these days, or whatever that process is for you guys. Typically, though, there's a process still that's fairly manual, where a department head looks at the hours for their department for the pay period and says, yes, these are good hours, or no, I know that this employee didn't work 48 hours straight. We think we may have missed a clock in or clock out. So there's a process of reviewing it, and there's a process of adjusting it. And then at that point, the payroll gets processed for payment and the checks are signed by the administrator. One of the things in this administrator you might want to periodically have a look at is get the pay rate file, making sure that the pay rates that are in your system are reasonable for those positions. that, we've seen situations over the years where a payroll, an HR person or a payroll person will increase the pay rate for one of their friends in the payroll system and take a cut of it off the back end or something along those lines. So looking at those pay rates and just making sure they're reasonable is probably not a bad idea. You don't have to do it every month, but if you do it every once in a while, you'll keep those unauthorized changes from happening. And it's interesting information too, in terms of motivation and some of those things. And then these days, we're not seeing a lot of paychecks. We're seeing fewer and fewer of them every time around. We'll see paychecks in some situations where, we might say if an employee terminates, we'll hold their paycheck until we'll do the final check as a paper check, pending them bringing their uniform, name tag, whatever, whatever it is we want. We actually have seen some people continuing to use paychecks because they distribute paychecks at in-service to incentivize people to come to in-service. But generally, people are going away from them. They've even got some capability now where we have a number of employees that don't have bank accounts and don't want them. But you can actually do a paycheck that gets put on a debit card without them having to have a bank account. So a number of ways to do that, but if you add paper, you add risk to the process. So the trend overall is to get away from paper. So remember, I may have mentioned this about 15 times already, but salaries are the biggest number on your income statement in the expense section. So it's something that we spend time managing. And so one of the things we look at is how do we control that cost? One of the ways we control it is by making sure that everybody's getting paid the rate that's authorized, right? That'd be really great. But also looking at adjusting your schedule immediately for census. If your facility has, a lot of facilities have census standards or payroll hours standards. If our census is this is the number of aides, the number of LPNs, the number of RNs. Making sure that we understand what those standards are for our facilities and adjusting to them as the census goes up, especially as the census goes down, right? If you have to use overtime and contract, neither of those are a bad thing, unless it's the only source of staffing that you have, right? If we're going to use overtime or contract labor, use it for shifts that nobody wants. At least the people are getting paid, or use it to relieve key employees. There's a lot of burnout, it seems to me, like these days from the people I'm talking to. There's a lot of burnout in our staff right now. It's a hard time to be in this business, and I'm certainly appreciative of that. We might use contract labor, assuming they can screen properly. We might use contract labor to relieve some of our key employees. We don't want those key employees, and we all know who they are. We don't want those guys burning out. And again, as I mentioned before, looking at direct care staff hours per patient days, that's a pretty darn good benchmark. Okay, so that's accounting processes. Everybody okay? Let's talk about what I've cleverly titled other accounting stuff, because it doesn't really fit anywhere else. Some of this is pretty crazy, so stick with me. And again, if you have questions, ask questions, because some of this stuff is we're getting down in the bean countering weeds at this point a little bit. The first thing I want to talk about is capital assets. Everybody's heard of depreciation, right? You've heard the word. I don't think it's misunderstood, and it's not all that difficult a concept, but it takes some getting used to. So the concept behind depreciation is this: if we have a computer or a lift or a piece of kitchen equipment or a new roof on our building or the building itself, we know that that's going to last us more than a year, right? So think about this. if we were to basically purchase all new beds for our facility, for example, we've seen some of that happen over the years. If we were to purchase all new beds for our facility, we expect those beds to last 5, 10, 15, a long time, right? Some of us have probably got beds that are older than we are in our facilities, right? Yeah, I hear you. We expect them to last a long time. What would our income statement look like if we bought beds and ran them right through the expenses section? Right? It looked bad, right? But we don't expect to use those beds up right now. We expect to use them over 5, 10, 15 years. What depreciation does is it says, instead of recognizing that cash outlay at the time entirely when we pay it, we're going to spread it over the period of time that we expect to use that asset. So it's a capital asset or a long-lived asset or property, plant, and equipment. There are a number of different names for it. But what we basically are trying to do is say, if I buy $100,000 worth of beds for my buildings, and I run them through my income statement is going to be distorted, right? And the last thing we want is a distorted income statement, because now it looks like we had a bad month when really all we did was buy some beds. That's not what we're at. Okay. So the way depreciation works is we basically say, we're going to identify expensive items that really last more than an accounting period. And the expensive items is an important component. Depends on where your building is, $1,500, items that cost more than $1,500. Medicare says items that cost more than $5,000, we should capitalize. If they're less than that, they're basically saying it's a small enough amount that it won't distort our income, so we'll go ahead and write those off, and keeping track of it, keeping track of a $200 cell phone for 4 years, it ain't worth it, right? But keeping track of a $70,000 van for 4 years is probably worth it. I don't know where the line is in your facility between the $200 cell phone and the $70,000 van, but I guess it's somewhere in the middle. So we're not going to capitalize everything. We're going to try and be practical about it. But your facility should have a capitalization policy that says, for an asset that's expected to live to last more than 1 year and costs more than X dollars, we are going to not run it through the income statement. We're going to do what's called capitalizing it, meaning that we stick it over on the balance sheet as an asset, and then over time reduce the value of that asset and run it through our income statement in little pieces. Okay, so that's our concept. Let's look at some numbers on that, shall we, and see if I can get it. That's the big concept. That periodic reduction, the part that we pull into the income statement every year to reduce the value of that asset over time, that's depreciation. Okay. So let's say we buy a computer that costs $2,000, and that is above our capitalization threshold, meaning that we've said everything above $1,500 that's going to last more than a year, we're going to capitalize that. We're going to put it, we're not going to recognize that all at once. Everybody with me? $2,000. We say we expect that to last 4 years. In fact, there are tables out there that tell us, we can find, your accountants will have them, possibly, tables that tell you how long an asset should last. Now, I've seen some homes that have green screen computers still in them too, so there's how long it should last, and there's how long we squeeze life out of it and how long it's practical. And those aren't always the same, but what we basically say is we're going to recognize it over 4 years. Recognize meaning we're going to pull it into our income over a 4-year period pro rata. Here's the other thing, this $200 salvage value. I think salvage value will probably be on the exam. As a practical matter, we never, ever, ever see it. But what they say is at the end of its life, at the end of this 4-year period, that computer is going to be worth $200, maybe to trade in, maybe to sell, something of that nature. At the end of that life, though, it's going to be worth $200. So we're not going to pull the value of that all the way down to zero over 4 years. At the end of 4 years, it's not going to be worth zero. It's going to be worth $200. So the way we do the calculation, and this is straight line depreciation, is we say it's worth $2,000 now. At the end of 4 years, it's going to be worth $200. So $1,800 is the amount that we're going to pull into income over a 4-year. We're going to use up $1,800 worth of that equipment over a 4-year period. We're going to use up $1,800 worth of good out of that computer over a 4-year period, right? So then the math gets real simple. We take 1,800 divided by 4, and $450 a year is what that asset costs us. So if you were to look at your balance sheet, which is again the third page in your little numbers set that I've given you, you'll see capital assets and you'll see accumulated depreciation. When we buy that computer, capital assets is an asset. Assets have a normal debit balance, right? Everybody remember that? Assets have a debit balance. So we're going to debit capital assets for $2,000, and we're going to credit cash for $2,000. So at that point, capital assets that computer is in capital assets on our balance sheet. Every year, we're going to add $450 to what we call accumulated depreciation. That's all of the depreciation that we've taken on those capital assets over time. So if we just had the computer, we have a capital asset of $2,000, and at the end of the first year, we have accumulated depreciation of $450. So at the end of that year, it would be worth $1,550, right? The two numbers netted together. We bought it for $2,000. The first year, we used up $450 worth of it. That $450, remember, double entry accounting, you got to have a debit and a credit. Accumulated depreciation has a credit. The debit would be an expense on our income statement, a depreciation expense. So now instead of pulling $2,000 through our income statement when we bought it, we're just pulling $450 through. This one makes people's head hurt. I'm sorry. The big picture is this. If it's an expensive item, we're not going to expense it. We're not going to put it on our income statement all at once. We're going to put it on our income statement over the period that we expect to use it. The way that you calculate that, and again, this is one where if you're going to memorize something, this is another one to memorize. The way that you do it is you basically say, what does that asset cost us? What's it going to be worth at the end? That's called salvage value. And what we're going to depreciate or take into our income statement is the difference between cost and the salvage value. We're going to use up, said differently, we're going to use up $1,800 worth of that asset over a 4-year period. The way you calculate the depreciation expense for each year is to divide the part you're going to use up by how many years you're going to use it. So the part you're going to use up is $1,800 because at the end it's going to be worth $200. And we divide that by the number of years that we're going to use it. Fun facts about depreciation. Yeah, that's what you wanted to hear, right? Fun facts about depreciation. Medicare and Medicaid cost reporting require that depreciation be done on the straight line basis, meaning evenly recognized. The amount we're going to use up gets used up, recognized evenly over a 4-year period or whatever our useful life is. For tax purposes, we use something called accelerated depreciation that basically uses up more of it right after we buy the equipment. So you might double the depreciation in the first, you might take 900 in the first year, 450 in the, 225 in the second year, and 225 in the third year, something like that. It's a declining depreciation that's front end weighted. That's what you'll see on your tax returns. Again, your accountants will have software that does the depreciation for you for tax purposes. If you have your accounting done for financial reporting purposes, so not for tax, your accountants will also probably be depreciating that straight line. Remember, we talked very early on about generally accepted accounting principles, GAAP, which are basically the rules of the road for accounting. Straight line is the way is GAAP. So that's the normal way to do things for financial reporting. Questions on that? That was about 3 weeks. That slide was about 3 weeks of accounting courses. So sorry about that. Okay. I want to talk a little bit about protecting your facility's assets. And the way we do that is through something that we call internal controls. Again, this is something that is discussed in some length in your texts, but I want to talk a little bit about concepts for internal controls. And the first one is segregation of duties. And what we say is that to adequately, basically, if you have two people acting together, right? Two people working together, they can rob you blind. That's just the way it works. We have internal controls, though, to keep one person acting alone from robbing. That's the whole point of internal control. Now, there are the first component of internal controls is processes. So remember, we talked about the vendor payment process where we approve an order to be purchased. We make sure that we got what we asked for. We make sure that we are only paying for what we received. That process, that's a process. We talked about bank reconciliation before, right? Where we go through and we look and we see, did all of the transactions that hit our bank also hit our books? That's a control process. But there's also a people side of the process, and that really involves something called segregation of duties. Big picture on segregation of duties is this. There are 3 types of responsibilities in an accounting cycle. The first one is having access to assets. What's access to assets? Can I lay hands on blank check stock? Do I know how to transfer funds in my bank account? Do I physically have access to the storage closet? Do I accept payments from patients, residents, or their families? Do I have access to signed checks? Access to assets, meaning can I literally lay hands on an organization's assets? The second piece of it is doing the accounting. When you think about the accounting, what I'm really talking about is posting. So when a payment gets received, do I have responsibility for entering that payment from the resident or their family or Medicare or whoever? Do I have responsibility for putting that into the system? Does it go through me to do that? If I have an invoice, am I the person that enters that invoice into our accounting system after it's been approved for payment? If we run checks, do I have the responsibility to run those checks, select which vendors get paid and how much, and run those checks, and can I prepare those checks for vendors? The last responsibility is reconciling. So do I have responsibility for checking the bank statements, reviewing the bank statements? Do I have responsibilities for reconciling the deposit slips to the daily postings in our accounts receivable or our billing systems? Am I doing reconciling procedures? The rule is really pretty simple. An employee who has access to assets shouldn't have either of the other two responsibilities. Do I enter pay rates in my payroll system? That's access to an asset, right? I realized I hadn't given you a payroll example. That's one. Do I approve hours? And do I have the ability to alter hours? That's access to assets, right? Because depending on what I put in, the facility's assets can go out as a result of it. So you need to think about it in those broader terms. So an employee with access should not perform reporting or monitoring tasks. Access should be isolated, or ideally should be isolated. If it's not isolated, you should at least have something around it or some other procedure to keep, be aware of the weakness in that. Be aware that it's not isolated and have procedures around that to protect your assets. So let's try this. Again, the point of segregation of duties and internal controls in general is to keep people honest and to keep an individual from acting alone. What you'll see as we look through this is if you have two people working together, then even your best internal controls can be insufficient to stop that. So, the good news is most of the frauds and thefts that we've seen have not been due to more than one person collaborating or colluding. They've been because internal controls were just not very good. And so now this is the part where I tell you horror stories. How does that sound? Let's talk about cash receipts. So the way that our processes work is that our business office manager receives resident payments in cash or by check, and that may be a check from an insurance company or a check from an individual or whoever. And they prepare the bank deposit and they post those payments to the cash receipts journal. This is probably the most common type of theft we see in nursing homes, because what happens is the business office manager might pocket that cash or check and post an adjustment to the resident's account. So rather than posting cash, they post an adjustment. When you post the adjustment, the balance goes away so the resident doesn't continue to get billed. And so nobody's ever the wiser. So what happens is, you basically don't even put the payment on the deposit slip. So you might say to me, yeah, well, Chris, we only really get payments by check. Nobody brings cash anymore. Guess what? If you're relying on the bank to be part of your internal control process, that's not going to work. We had one situation several years back where a business office manager had incorporated, and she was working, let's call the facility Happy Village. The real operating name, any nursing home worth its salt has got three names. The one on the sign out front, the name of the corporation that operates, and then there's another one usually somewhere, what it used to be known as. She basically set up an LLC called Happy Village LLC. They got checks made out to Happy Village because that was the name of the sign in front of the nursing home. That wasn't the name of the corporation, but that was the sign in front of the nursing home. She took those checks, endorsed them, and deposited in a bank account called under her LLC, Happy Village LLC. Smart. So don't rely on the notion that we don't really get much cash. A determined individual will find a way to take those checks off your hand. I mean, if you think about it, they can endorse a check, basically, and that becomes like cash. Anyway, the way that you deal with that is that you isolate. So what's gone wrong here is the business office manager receives resident payments in cash or check. From our segregation of duties talk, we know that that's access to assets, right? She prepares the bank deposit. I'm still okay with that because you have to have access to assets to make the bank deposit, right? And she posts the deposits to the cash receipts journal, except she posts adjustments instead of deposits. You see what happened there is we got into the accounting side. So she's doing the posting. She's got access to the asset and she can do the posting. So how do you deal with that? Well, you basically have the business office manager has to do the posting because she's the only one or he's the only one that knows how to use the accounting system. What you basically do is you say, you're going to post the payments from a list or from a detailed deposit slip. We'll give you copies of the documents to post from, or we'll make a list for you to post from. But you don't ever lay hands on the actual documents. You know, what you might have is a receptionist or somebody that's at the front desk receive those payments. Now, you can't be too radical about this stuff though, too, because, you know, what happens if the usual person that receives cash payments is, or you know, opens the mail or whatever, is off work on a particular day? Do you just let it sit in the envelope or basically say, I'm sorry, the person that takes cash isn't here right now. You'll have to come back later. Nobody in their right mind is going to say that, right? So you have to make allowances for those sorts of things. But what you might have is a policy that says the business office manager doesn't take payments on a routine basis. Maybe you're willing to risk one payment getting from a customer service perspective. But if it becomes a pattern where that's what that individual does all the time, then you've got potentially a pretty good size problem. Okay. How about this one, vendor payments? Let's say we're picking on the business office manager. Sorry, that's just kind of how this works. Let's say that their responsibility too is to prepare checks for the administrator to sign. And then they get those signed checks back and stuff the envelope. And then at the end of this process, the business office manager also does the bank rec. Why is that important? Well, let's say that the business office manager takes a signed check. By the way, a signed check is an asset, right? So we've got access to an asset right there. The fact that they can prepare a check even before it's signed also makes it an asset, right? How hard is it to write somebody else's name? And again, by the way, the banks aren't comparing signatures, right? I write your name on your facility's check, it's getting cashed. That's just how it is, right? So blank check stock is just as good as a signed check. I guarantee you that I can complete a check in crayon and sign it Mickey Mouse, and 9 times out of 10, the bank wouldn't notice anything unusual about it. That's just how it works. Now they're willing to sell you a service, prevent that from happening, and it might be worth it. But the banks are not a control you can rely on. That's not critical of the banks. They just got a huge volume of transactions. So the business office manager takes a signed check, changes the payee, and cashes it. The business office manager is the only one who sees the bank statement when it comes back. So you sort of think to yourself, well, you know, if I get the bank statement unopened and I can look through the enclosures, I'm going to notice a check that's written out in crayon and signed by Mickey Mouse, right? But if the person who did the crime is actually in charge of monitoring the bank statements, guess what? Nobody else lays eyes on it, they get away with it. So the other issue is, so then what happens is the business office manager, what you can do is have them prepare checks and stuff the envelopes, but not let them do the bank reconciliation. Or as a practice, if you really want to have some fun, I don't know if, it seems like a lot of the facilities we work with are still getting bank statements, like getting paper bank statements every month. As the administrator, tell the receptionist or whoever opens your mail that you want those bank statements and you want them before anybody else opens them. And so what you do is you take that bank statement and you just kind of flip through it and look for anything that looks odd. It's a surprisingly effective control that takes very, very little time. You don't spend a lot of time with it. If there's something weird on it, on those little 6 per page copies of all the checks and deposits, it'll jump out at you. You'll see. You know, and I'm not even saying you need to do it every month, but do it often enough and maybe ask a question. That's segregation of duties. Okay. We're going to leave GAAP for a little while and talk about sort of practical accounting or cost accounting or management accounting. This is really more, this is not about financial reporting at all. This section is really more about understanding the nature of our expenses. It works like this: variable costs. We have two kinds of costs: variable costs and fixed costs. Your variable costs should change with some driver. The driver in our business is census, right? Patient days. If you have an expense that should go up or down based on how many people you have in the building, how many residents you have in the building, that's a variable cost. Things like, we talked about it already, right? Food costs, direct care staff cost, medical supplies cost, rehab, ancillary services. Lots of those things should change as your census changes. Those are variable costs because they vary. Here's a rule for you. So the other piece of it is fixed costs. If a cost isn't going to change as your census goes up or down, or shouldn't change, and remember, I'm using the word shouldn't here. I'm using it on purpose. If a cost shouldn't change when your census goes up or down, it's a fixed cost. Here's a rule. All of your costs are fixed unless you make them vary, right? All of your costs are fixed unless you take action to make them go up or down with your census. So let's talk about that for a minute. So what are the fixed costs? Fixed costs might be, we're always going to have one director of nursing, right? So our DON cost salary is probably fixed. Our facility rent is probably fixed. Our liability insurance, our property insurance, those things are fixed. Food cost is going to vary. Direct care staff cost is going to vary. This is where I'm going to have some fun with you. Are you ready? What about housekeeping staff? Is that fixed or variable based on those definitions? What do you think?
I would say variable.
Tell me why you would say variable.
Because if your census drops and you close down a hall, why do you need housekeeper in the hall?
And the same thing, if you get more, you need more
Right.
people to help clean.
Right, exactly. Like with the COVID situation where you may need extra housekeepers.
Are they variable in the same way that direct care staff or nursing staff are?
I would say not as variable because there are still certain areas that need to be cleaned that you may not, I mean, your dining room, things like that, bathrooms. But I would say that you could be more proactive with changing up your PPD with your direct care staff than you could your housekeepers.
I'll buy that. What about your maintenance staff?
I'd say fixed.
It should be fixed.
Because you generally know how many beds are in the facility. Obviously, that's not
And
going to
it's the
change.
building.
Yes,
It's
the
still
building,
a
you know
building
what
day.
it's
There's
going to
still-
take to upkeep the building.
I've asked that question and I've had people argue the other side of that and say it's variable because the more residents you have, the more things get broken.
No, the more nurses you have, the more things.
You're making the same argument, you're just adding a step.
Oh, yes, I can say that.
All right, and what about utilities cost?
Variable, depending on the season. If it's colder, you're going to use the heater more.
But does it vary with census? Just because it's not the same month over month, what you have to ask yourself is, can I do something to change that cost?
And because you you should, like, the room's not being used, you can close those vents and save heat and air that goes in there.
Okay, so you're making the same argument that Tracy made with housekeeping staff. Basically, if we close off a wing, then we ought to expect that cost to be very.
Even the more resident you have, the more water you use.
That's right. The more, yeah, so that's very.
So it's fair.
I think you guys have got the idea. You're making the right arguments. Good job. Okay. So variable and fixed costs. Again, the idea is that variable costs change. Generally, the driver is census, not that they change on their own. They change if you make them change. Fixed costs generally don't. There's another classification of costs. So variable and fixed are two dynamics. Another two dynamics are direct and indirect costs. So with direct costs, you're talking about costs that are related to revenue centers. And again, this is a concept that is probably going to be on the exam, but that I don't think applies to nursing homes in any way. So, but let me give you an idea. What do we provide? How do we earn revenue? Excuse me, by providing services. What services do we provide?
Therapy services,
Therapy, nursing,
food,
okay,
supervision.
Nursing. Is our facility part of part of what, that they're living with us, right?
We provide electricity.
Yeah, yes. The argument or the way that you're looking at this is exactly why this doesn't apply to nursing homes. We can't basically say, we make widgets, right? And the cost of those widgets is the materials and the labor related to the people who are actually putting the widgets together. That's a manufacturing example. That's what they're looking for. Indirect cost would be your administrative services, the billing side of what you do, and again, in the widget making area, the people that are sweeping the floors after the fact. So basically, if the expense is related to producing the good or service directly, it's a direct cost. If it's not, it's an overhead cost. Like I said, it's a great concept for manufacturing. It has almost no relevance for what we do. But there it is. The direct cost relates directly to producing revenue. An indirect cost is what you would consider an overhead cost related to producing revenue.
So administrative service is indirect.
Say again?
Administrative services would be indirect.
Yes, administrative services would be indirect. Pretty clearly. There are some areas that are pretty clear. You know, food's pretty clearly a direct cost. But, you know, we're providing a room, we're providing space, we're providing lodging, accommodations, all of that. That's kind of a direct cost for us that wouldn't necessarily be in a different type of organization. So, yeah, you're right. I'm not going to dwell on that one, but that's a concept that you're probably going to want to understand. Direct relates to revenue production, indirect is overhead. Okay, break-even point, and I've got to apologize to the people that are listening that are not in the room. The example that I have, I neglected to get in the handout for break-even point, so we'll do our best to sort of get through it on the screen, and it goes pretty well. So all right, so your break-even point works like this. If we have fixed costs, right? Fixed costs don't change. So we're going to abandon direct and indirect for a minute and go back to fixed and variable. Remember, variable costs should change with census. Fixed costs don't change with census. The break-even point is the point where you've got enough of a census in our business, in our industry, where you've got enough residents, where the revenue from those residents minus the variable cost is enough to cover your fixed costs. So the break-even point, what we're trying to do is answer the question, how many residents do I need to cover my fixed cost? So that what's left after I subtract my variable cost covers my fixed cost. This is another one of those concepts that, I'm sorry, it's one of those things that we've got to learn, and it's a tough one. Again, another 2 weeks worth of accounting class to learn this, and I'm going to try and force feed it to you in 15 minutes. So how many residents do we need so that when you take the revenue from those residents and subtract the variable cost related to those residents, it's enough to cover our fixed costs? Okay? I think the easiest way to illustrate this is to sort of walk through the math. All right. So here's what we sort of think about is it's almost easier to look at break-even point on a per patient day basis. If variable costs vary with your census, looking at it on a per patient day basis should be a pretty smart way to go about this. So what we're going to do is we're going to say that our revenue per patient day is $150, okay? Our staffing costs, which are variable, are $60 a patient day. Our food cost is $8. Our medical supplies are $3. So that gets us to $71. So our variable costs are $71. Are you staying with me okay? Our variable costs are $71. What that means is the margin, or when we take our revenue and we pay for all the variable costs, what's left, that's what a margin is 79 bucks. 150 minus 71 is 79. Okay? So we've got $79 a patient day left after we pay for our variable costs. Okay? We've got fixed costs of $1.5 million. So the question we ask ourselves is, how many of these $79 a patient day do we need to cover $1.5 million of fixed costs? So I'm going to walk through that one more time. We have $150 a day that we're bringing in. Our variable costs, those costs that change with our census, are $71 a patient day. So we're bringing in 150, we're paying out 71 on the costs that move up and down. That leaves us $79 a patient day to cover fixed cost, right? So the question is, how many of those $79 a days do we need to cover our fixed cost? Well, the answer is pretty easy. We divide $1.5 million by 79, right? If we have 79 bucks left over after we pay our variable costs, how many of those $79 do we need to cover $1.5 million? Well, it turns out that there are 18,987 79s in $1.5 million. So the patient days required, that's our break even. Based on this scenario, we need 18,987 patient days to cover our fixed cost. Let's think about that in terms of what does that mean? Well, let's test it out. Since you can't have 0.34 patient days, right? You can only have a whole patient day unless you've got a third of the patient at the bed. So yeah, we're going to round that. We're going to have a little bit. So if we take our patient days times 150, which was our revenue, we had $2,848,50 of revenue. With me? That's how much revenue we have at that break-even level that we calculate. We had variable costs at $71 a day. Everybody remember that? We had variable costs at 71 bucks a day. So 71 times 18,987 is 1,348,101. We take our revenue of 2,000,008 minus our 1,348, we've got 1,000,005. That's actually not right. We've got a little less than 1,000,005. If we take that 2,000,008, subtract 1,348,000 into our fixed cost from it, we wind up $51 in the hole. So what we've said is 18,000 days, 18,987 days generates that much revenue. We have this much food cost and staffing cost and whatever else we deem to be variable. We know we have fixed costs of that amount. We're left with a $51 difference. That's what break even is designed to say. So here's what happens. You add one day, you go to 18,988 instead of 987. That's 71, that's $79 margin we generated. That's all bottom line. We don't have any more fixed costs for that to cover, right? So to say that differently, we change this, I hope this works, we'll see. We change that to 18,988. Yeah, so it looks like it's getting a bigger negative. I've got the formula. Yeah. So as our patient days go up, we get to keep those big chunks. We get to keep the whole $79 past the break. That's another hard concept, guys. How are we doing? Again, break-even point, you take your revenue minus your variable expenses. How many days does it take to cover your fixed expenses?
You say it at the end, please.
Right. Break-even point is the number of patient days for us that it takes so that what's left of your revenue after you subtract variable costs covers your fixed cost. Break even meaning we get our bottom line to zero. So the excess of our revenues over our variable costs is enough to cover fixed cost. Okay, wow. Here we go. The last big topic we're going to tackle is budgeting. Remember I said that one of the pieces of financial management is setting an expectation for financial performance and then measuring against it. That's what budgeting is. Now, I'm going to start sort of at the bottom of this slide. There are three types of budgets that we might talk about. The first one is called an operating budget. And when you talk about an operating budget, that's generally what we think of as, we think our income is going to be at this level for this upcoming year. We think our expenses are going to be at a certain level for the upcoming year. And then we're going to sort of measure against that expectation as the year goes on. So it's sort of projecting out your net income and then measuring to see where you wind up. There are two other budget types. One of them is a cash or working capital budget. The reason you use a cash budget is to figure out how you're going to pay your expenses that might come up. So in the situation where this nursing home that I've been using as an example is in, where we've got $515,000 worth of liabilities and $220,000 of current assets, I'm probably going to need a cash budget or a working capital budget to figure out how I'm going to make up that almost $300,000 shortfall, right? So the purpose, excellent. The cash or working capital budget is designed to, the cash or working capital budget is designed to figure out how to make your cash flows work. The last type of budget is a capital budget. And in that circumstance where you've got a significant facility renovation or a rebuild or maybe a software installation or some sort of major expenditure coming up where you've got a sort of a long-term asset that you're building. Again, it could be a facility or a renovation, or software installs are expensive as all get out these days, so on and so forth. The capital budget is where you sort of go through the process of figuring out what that project is going to cost you, and then looking at how you're going to pay for that project, whether that's a financing plan or additional revenues from the renovation that you're doing or what have you. But we're going to focus our time on the operating budget because that's the kind that we most commonly see, and we think to a certain degree is probably a little bit underutilized in the industry. And I think when you look at budgeting, there's kind of a process that you need to go through. A lot of the budgets that get done basically take last year's numbers and say we expect last year's numbers to be the same as this year's numbers to be the same as last year's numbers. If we did that for calendar 2020 based on 2019's numbers, how well do you think that's working out for us right now? It's a different world, isn't it? So, and I'm not sure that assessing the environment would have necessarily gotten us there anyway. I'm not saying that, but what I am saying is that you sort of have to look around. In Oklahoma, we got a pretty good Medicaid rate increase back in October of last year, and we knew that we were working toward that. So if you projected 2020 revenue based on the average rate that was in effect for 2019 for your building, well, we only got that higher rate for 3 months, right? So we've probably missed revenue by not sort of thinking about what's changed in the environment. We had a period a few years back where the price of natural gas went through the ceiling and then subsequently went through the floor. So, you think about that environment and what are those costs going to be? We had a situation around here where Oklahoma was one of the most, nursing homes were one of the most litigated against of any state in the union. And our liability insurance costs went through the ceiling. And, if we didn't predict that, our budget started to look pretty funny. So what I'm saying is when you start to think about budgeting, the first thing you want to do is trying to look out next year is just take a little time and think about what the environment looks like. And maybe you start with financial statements. The second piece of it is to sort of determine, maybe what's changed in your facility year over year. We've hired a new person to do billing and collections, and the bills are getting out more timely, and that's resulting in the collections being more likely to happen. Our payment system, we're doing, because we've invested significantly in training for PDPM, our Medicare revenues are actually up significantly more than the industry at large. Or, a local employer went out of business that competed with us for staff, so we're actually able to retain and stabilize our workforce a little bit better, or staff up a little bit better, or whatever that looks like. Or, we went from a institutional dining model to a menu-driven dining model. All of those kinds of things. So think about what's changed in our facility from one year to the next. And from there, you take all of those inputs and you sort of project your revenues and expenses. And we'll kind of go through that. And those concepts of fixed and variable costs are going to come into play as we talk through it. Once you've got that sort of put together, you sort of have to give your budget a kind of we call it a smell test. Basically look at it and say, does this really make sense? And probably equally as importantly, if you put all of your assumptions in there and look at it, and you have either a huge net income or a huge net loss, you probably ought to think about whether that makes sense too. So really just giving it a smell test or a once over, or just saying, does this actually make sense? So there's a fair amount of that. There's a fair amount of that that goes on in the budgeting process. So what we're going to do is spend a couple of minutes, and these will actually be the last few pages in your handout that has the financial statements on it. So you might pull those open. We're going to sort of go through and talk about some of those. Okay. I think a lot of things start with revenue. So when I'm doing a budget, I always start with the revenue budget. So does everybody sort of see this page? I think the top line says something like revenue budget. Revenue budget and volume assumptions. Everybody got that one? It should be the first page after your income statement. Kind of a good place to start is your last year's financial statement. So for December 31st, 2019, we had Medicare revenue of this and Medicaid $1.9 million and so on and so forth. So our revenue number was $2,781,000, right? That's what we achieved in 2019. That's probably a pretty good baseline to think about. So one of the ways you think about that is, well, what changes from year to year? Well, for Medicare, we expect we know we're going to get some sort of an increase. And we take the pandemic out of the picture, but we have a new payment system. We think that's going to increase our Medicare payments by 15%. So what we might do is say that we're going to add 15% onto to the actual rates there. So our Medicare budgeted number now, $562,000, $561,800, compared to the $400,600, the increase there. On the Medicaid side, we got a rate increase at October 1st of 2019. When we put that rate in effect for the full year, we look at that and we expect Medicaid revenue of $2,456,000, right? Private pay, since we got an increase in our Medicaid rates, we decided we're also going to raise our private pay rates a little bit. Because ultimately, what are we going to have to do with that rate increase that we got? We're going to have to pay some staff with it, right? Because the facility down the street is paying some staff with it. And we might say that our provision for bad debt, we got a new business office manager, so we think that's going to go down. So as we've predicted all of this stuff, we're saying that our revenue is expected to go from $2,781,000 in 2019 to $3,481,000. None of those assumptions are unreasonable, right? We got a rate increase, PDPM's a new payment system that will do pretty well on. So our revenue, we think, is going to go up. That's our summary. But when you scroll down and sort of look at it, another driver is our patient days. So we had 1,230 patient days last year. But as we trended toward the end of the year, our Medicare census was rising. So we're expecting maybe another 270 patient days to get us to 1,500 for calendar 2020. For Medicaid, we expect decreased use of contract and Medicare admissions to help increase our overall census by 5%. So basically, we're going to use less contract labor as we stabilize our workforce with those additional Medicaid funds. And we think that's going to result in more engagement with residents, which means they're less likely to leave. And our Medicare admissions, what we're saying there is basically we're going to convert some of those increased Medicare admissions that would be new admissions for our facility. We're going to convert more of those to long-term care admissions following their skilled stay. And private pay, same general idea. So we think our patient days are going to go up by about 6.6%. So we factored in those patient days and those rate increases, and that gets us to the revenue number that we're looking at here at the top. So we've got our revenue budget, and we've actually got our days or our volume adjustment, right? We've got our days prediction. Why is that important? Because we're going to use those days to predict our variable costs, right? Okay. Let's see. But you can see that the process here is we're actually thinking about how all of the pieces fit together and what might have changed. So, when you start looking at expenses, one of the places you sort of ought to start with is salaries, right? Because I may have mentioned this 15 times. Salaries is the biggest number on your income statement. It's not revenue, right? So thinking about that is, here are our employee categories and the departments that they're in. This is what their actual salaries were in 2019. And here are the FTEs, right? Here's how many employees we have. And what we're going to do then is we're going to start with budgeting FTEs. And we're saying so I'm making your argument for you here. If our staff, if our census goes up, we're going to need an extra half an FTE in housekeeping, laundry, and dietary. So we're going to increase those staff as a result of that. Also, because we got a substantial rate increase from Medicaid, we're expecting to perform pretty well under Medicare. We think the market is going to require us to give raises in the neighborhood of 8%. So now we start with this salary and those FTEs. We increase the FTEs, we increase the raises. And now we've got good grief, I'm sorry. Now we've got budgeted. So now our budget has gone from $1,271,800 to a budgeted amount of salaries of $1,395,000. Oh, yeah, I didn't see this up there before. We've actually made an adjustment to nursing too. So that's your RNs, LPNs, and aides. We've made an adjustment to nursing to say we're actually going to add 2 FTEs as well. We think we're going to need an additional MDS coordinator because of the changes in PDPM. So we're going to add an MDS coordinator, and then we're going to add another LPN or aide or somebody because we think the volume is going to require that. Because we projected some additional patient days. Okay, so from there, we sort of go down and look at our other expenses. So this is your non-salary expenses. Facilities lease, So your facilities expense or your occupancy cost, rent, property insurance, and taxes. We don't expect there to be anything on that other than an inflation factor, right? Just over time, premiums go up, and there may be an escalator in our rent clause that says our rent expense goes up by 3% a year or 4% a year, something like that. Your benefits expense, you know, if your salaries go up, your Social Security and Medicare go up, right? So we're going to have some lift. When we have more salaries, we're going to have more benefits as well. Administrative supplies and other expenses, we're basically saying, you know, just inflation over here. You know, your quality of care fees is going to go up partly because our quality of care fees are paid based on our patient days, right? So if our census goes up, the quality of care fees go up. And our quality of care fee, we also expect the rate to go up. Remember that quality of care fee is based on revenue statewide. And if statewide the revenue for nursing homes goes up, the quality of care fee should go up as well. And so on and so forth. So you sort of look through here and you see, you know, liability insurance. We've checked with our insurance carrier and they think that the prevailing rates are actually going to go up for the industry. It's a big number we might want to check into. Repairs, you know, we might say that we have to make more investments in our plant, in our physical plant, and so on and so forth. I'm not going to belabor this, but this I probably think I already have. But the idea here is we think about the costs in our facility and what's going to change. An easy way, you know, the prior year is an easy place to start, but we think about inflation, we think about volume, and we think about known changes that are out there. When you're done with that, you've got your expense budget built as well. Start with your revenues, start with the assumptions, tackle the individual items in the expenses, and think about how those might change. And so when you're done, you have a budget summary. And this just summarizes what we showed before. So whereas last year we had a $593 loss, we're projecting for 2020 to have a $406,000 net income. Which, given that we've got a 17% increase in our Medicaid payment, and we're giving 8% of it back to our employees, probably makes some sense, right? 17% is a lot. Okay, so we've got our expectation built. Remember I said we start with expectations. One of the things I want to say about the budgeting process is that when you're developing the budget, don't do it in a vacuum and don't do it by yourself. You are going to have have people buy into it, right? If you're going to hold your nurse scheduler accountable for your staffing costs, your dietary manager accountable for food costs, and so on and so forth. If you use the budget the right way, those people will need to have bought into it. And the easiest way to get buy-in is to get them involved in the front end in developing the assumptions that your budget's built around. You get people involved in a process like this for two reasons. You want their expertise or you want their buy-in. In our case, we probably want both. So don't do a budget and inflict it on your people. Build the budget and involving people in the process. Okay. So the last thing in this process is now we want to use the budget. And so what we might do is we would say for our budget for the month ended, so this is the holding people accountable part. For the month ended July 31st of 2020, this is what we budgeted. This is our actual month ended. Part of that process is looking at your actual versus your budget and trying to understand what's different. And what's different is that, you know, on the Medicare side, we didn't have much by way of change. You know, private, we actually wound up with an 8% variance over our budget. And maybe that's because we had some private rooms that we were charging more for, and we actually had more interest in those private rooms than we thought we might. So that results in a higher revenue. you look down here at your other expenses, your facilities cost, for example, maybe went up by 30%. Your landlord may have gotten wind that you got a Medicaid rate and decided to escalate your rent for you. How kind. Your laundry, your resident days are higher than what we were expecting, so your laundry cost goes up. Remember, on this one, I'm not looking at it on a per patient day basis. I'm looking at it on a cost to cost basis. But so as you go through, social services, we invested in new materials that weren't budgeted to improve our resident satisfaction, for example, and make the activities programs more robust, and so on and so forth. So you sort of look through that, and when you get to the bottom, things all net out, and we're $550 ahead of budget. But the process of going through that budget and saying, where did we expect to be, where are we, and why were things different? That's a useful dialogue to have with our staff, and that's really a big part of financial. Questions on budgeting? Okay. I have a couple of last little pearls of wisdom that I want to reemphasize mostly. One of them is never pay vendors from statements, only invoices. The only thing we use statements for is to reconcile what's in our systems as being due to a particular account. The second one, minimize cash on hand. Make your bank deposits every day. If you get a payment in, go ahead and make the deposit every day. One way to control access to assets is for them not to be in the building. So get those deposits made on a daily basis. Third, consider if you do your own payroll, consider a payroll company to do that. In fact, the payroll companies, we're now seeing technology that allows, if we have an employee that needs to miss a shift, they actually have some peer-to-peer capability where an employee can, through an app, reach out to another employee and say, I'm going to miss this shift. Does anybody want to cover my shift? And if there's no overtime involved, that swap sort of automatically gets made, and it's pretty slick. Technology continues to improve. Consider positive pay. What positive pay is a service that you basically send your bank on a monthly basis a list of the checks that you wrote and the amount of the check, and the bank makes sure that the check clears for the amount that you wrote it for. That's pretty good. A much more expensive service, you can actually have banks scan signatures against approved signatures and other things of that nature and do some analytics. Right now, that's pretty expensive technology, actually, but we think that's probably going to cheapen over time, so it's something to keep an eye out for. I think the last thing I want to leave you with is this. I'm not going to apologize for my profession, but accountants, the job of an accountant is to create financial information, report financial information, and interpret it and communicate it. And an awful lot of us are really good at putting the information together, putting together reports that are right. Communication is something that we as an industry are not terribly known for. You've all heard the old, how can you tell if your accountant's outgoing? He looks at your shoes instead of his when he talks to you. I mean, that's the kind of background that we're known for, and it's for a good reason. We're not great communicators in a lot of cases. So what I would say is, in my experience, the best questions that I've been asked about financial statements didn't come from other accountants. They came from people who looked at the financial statements and said, this is not what I expected. Help me understand that this is what I thought this should be. Why isn't it? That's administrators, CEOs, and non-financial people asking those questions. So what I would say is, if you're looking at your financial statements and something doesn't look right, or you don't understand something, that's not your fault. Have the courage of your convictions, ask your accountants to explain to you why something isn't what you thought it would be. It may be an error in the financial statements. It may be a factor that you didn't understand. You never know what it is, but part of our job is to communicate. And if what we give you doesn't meet with what you expected, then we haven't communicated very well. Make us do that part of our job. All right. With that, I'm finished. We're done about 15 minutes early. I appreciate you guys being here today and putting up with me. And I'm around if you have questions. I think my contact information is on the first slide, so feel free to reach out.